Trump administration, Musk is in a, he continues to play chess, others playing checkers relative to this situation.
One of the big arguments, especially as the China-U.S. trade war really heats up, or trade dance, whatever you want to call it, there is a question about whether it pushes China even more to develop a parallel tech sphere to the U.S. that becomes dominant in its own right, that might be more amenable to a number of countries around the world. How realistic is that to you? Does that become more of a possibility?
I think it's not realistic just because of NVIDIA. I mean, we just continue at high-scale GPUs in terms of true build-outs. You need NVIDIA. There's one red phone that goes to Jensen. Now, obviously, DeepSeek, that was kind of the white-knuckle moment. Everyone's like, does this change the whole narrative? And I think as more has come out about that, people realize, maybe the bark is a lot worse than the bite. Look, you'll have a decoupling in terms of what's happening in China and the U.S., but in negotiations, it's so important because, again, U.S. needs China, China needs U.S. And I think that's why it's very, very important, especially when it comes to chips, that this could be a decoupling, but not get in the way of what I view as a generational tech environment in terms of, what we see with AI.
NVIDIA, monster run-up over the last few years. Got to say that up front. But 22% drawdown in the past few months. Why hasn't that stock recovered? We had a week, we worked out that DeepSeek is maybe not what people thought it was. And here we are, we're still rolling over.
Yeah.
Why?
And I think that there's a few reasons. One, it's just like Microsoft has, Apple, they've sold even after, I think, better than feared numbers. I think there's worries just in general about, like, can they continue to sustain it? If any little thing happens flying the ointment, stock gets crushed. So you've seen a little bit of a risk off, but look, I just continue to view it 6-9 months from now. We look back at this as a golden buying opportunity, not the time where there's something structurally wrong and numbers don't.
Or we've just found better vehicles to play the theme, which is Palantir.
But to that point, that's why you look at, like, again, if you look at that Palantir quarter, they could print that press release off, put it in the Louvre in terms of just how strong it was. And it shows what they're doing in terms of Palantir is, I believe, one of the best plays in AI. But to your point, look, as the second, third derivatives take hold, from Google to Salesforce to others, there's going to be other ways to play. It's not just about Mag 7. There's going to be others that play into this.
Next to the Mona Lisa, untamed AI demand.
Yeah, right to the left, and then there's, I think that could be where.
It's just a QR code to an NFT.
Special VIP tickets, something like that.
Look,
click on it.
It's 2025, man. Anything could happen.
It's good to see you.
Yeah,
thanks for dropping by.
Thank you.
A lot to talk about in tech right now, that's for sure. Dan Ives of Wedbush there. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hacker. Say, Yahara.
Hi, John. President Trump says his administration wants access to Ukraine's critical mineral resources in return for helping defend it against Russia. Ukraine has significant reserves of uranium, lithium, and graphite, which could be worth trillions of dollars. President Zelensky offered allies access to the resources as part of his victory plan last year. Meanwhile, UBS shares are falling 6% in Swiss trading as uncertainty over capital requirements overshadowed what were otherwise strong results. The bank reported a $770 million net profit and even announced plans to buy back up to $3 billion of its own shares this year. Plus, UBS saying it's on track to complete the integration of Credit Suisse by next year. PepsiCo shares are also falling in the pre-market here, down 2.3%, even though the company posted a beat on earnings. But investors are focusing on the beverage and snack giant's quarterly sales, which fell short of expectations. PepsiCo said its Quaker recall continued to hurt performance, and international markets remain affected by geopolitical tensions. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, pricing tariff risk.
I don't think this would necessarily be inflationary, given that the economy does have a lot of momentum, but I do think that the growth hit would be significant. We would notice it for sure.
Francis Donald of Manulife, up next.
about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
I'm prepared to be criticized for this. The last 24 hours, a masterclass in expectations management. Threatened to put tariffs on Mexico and Canada, hasn't happened, ended up with 10% on China, people barely blinking. 10% additional tariffs on China is a story, but we're sitting here this morning saying good news, avoided tariffs on Mexico and Canada for a month.
Perfectly said. You can broaden this out to say what actually is going to stick, what is the signal, and what is the noise when we have a fire hose of announcements coming out from Washington, D.C.
Under surveillance this morning, pricing tariff risk.
I don't think this would necessarily be inflationary, given that the economy does have a lot of momentum, but I do think that the growth hit would be significant. We would notice it for sure. The point of this isn't to slap tariffs and slow the economy down. It's to get what he wants from Canada, Mexico, China, and others.
And he's slowly getting it, that's for sure. Here's the latest this morning. The US dollar and Canadian dollar under pressure after leaders from both nations reached a deal to delay tariffs for 1 month. Francis Donald of RBC writing, US tariffs in the size that they have been floated, or even a fraction of that size, could filter into the Canadian economy immediately, significantly, and then persistently for many years. Francis joins us now for more. And Francis, maybe we've avoided them. Maybe they happen in 1 month's time. I don't know. But what I'd love to hear from you is the price of the uncertainty. What is the price that we have to pay?
Well, even though this trade shock that we look to have avoided would have been the largest in 100 years for the North American economy, we do have some things that we know about tariffs and the threat of tariffs from the 2018-2019 experiences. And one of them is even just the existence that they may occur has historically stalled business investment, household decisions. It creates an uncertainty tax on the entirety of these economies as businesses lack clarity on what will happen next. So it wouldn't surprise me if we see a pause in business activity, a hit to business confidence in the United States, Canada, and in other countries. And we see this distorting more of the Q1 data on top of a period which historically we have a lot of trouble understanding the data from for seasonally adjusted reasons.
Francis, the way that John put it earlier was some anti-growth measures were being floated and dealt with now by Donald Trump, and later there'll be the pro-growth measures. Are these hits to potential growth easily offset with tax cuts and some of the other proposals?
We haven't been able to make the math work on tariff revenue matching tax cut needs. But what's really critical here, and Lisa, I think you nailed it, is the sequence of these events. Trade shocks, tariffs, they're stagflationary. We know that to be true. They limit growth. they create inflation, but then you might see, for example, tax cuts that come through, deregulation, that tends to be pro-growth, pro-inflation. And I think what's key here is that almost all of the policies that we've heard floated from Washington do have an inflationary element, but markets will care less about that, and the US will be able to absorb more of that inflation if it comes with a side of growth. And that's why I think you're seeing a lot more concern about the inflationary elements of tariffs than you are, for example, the inflationary elements of corporate tax cuts. Now, underlying the surface, Lisa, I think the real inflationary story, and the one that should be concerning us most of all, is that the US lacks workers, not jobs. It is heading into a period where it's going to experience real demographic challenges. We expect the labor force participation rate to decline in 2025. We have the least amount of workers ever working in the United States right now, the most amount of retirees. If we see a change to immigration policy, in fact, we're already seeing some of that, we're going to see more challenges to labor supply. That's going to be the most nefarious form of inflation as it pushes up wages, good, but flows through the economy more broadly. So inflation is one word, but there's all different types of inflation, and all these policies carry different variations of good inflation and bad inflation.
Francis, there's so much uncertainty that Fed officials are saying very little, and a lot of people are cheering that and saying nobody knows. Have you seen enough to change your outlook for the year when it comes to growth, when it comes to inflation in the United States?
Well, we were prepared to downgrade our U.S. growth forecast if we had seen those 25% tariffs on Canada and Mexico come through. Those would have shocked U.S. growth by a full percentage point in 2025 and lifted inflation by half. As of right now, there's not enough, even with the Chinese tariffs, to really make a meaningful change in that outlook. But our U.S. rate strategist, Blake Gwynn, has a really good line. He says this Fed is going to be watchful, not reactive. Of course, the Fed is filled with a lot of economists, and I think economists on the street are going to be doing something very similar to that.
How much has changed, Francis, in the last 3 months? I was listening to some comments from the Chicago Fed president, Austin Goolsbee. It seemed out of sync with what I heard from him at the end of last year, that's for sure, before Trump got into power. We've got to be more careful with how fast to cut rates. What has changed for them?
Well, we may feel a huge sense of relief over the news from the past 24 hours, but remember this massive trade shock, and I got to be clear here, this trade shock, 25% tariffs on Mexico and China, would have brought the average import tariff for Americans up to almost 11%. It currently sits at 3%. It's a quadrupling of the trade pressure that would exist within the U.S. economy. It didn't disappear. It's been paused for 1 month. We still have the April 1st America First trade policy negotiations. We have USMCA being negotiated. We're hearing a lot of chatter about European tariffs, and then we have Chinese tariffs that came on. That, as you mentioned at the start of this segment, is still a massive economic shock, and it would have you reevaluate how you're looking at the economy in 2025, especially if you're a central banker. Because if you're a central banker in that situation, you're having to model growth down, inflation up. Some central banks only have an inflation target. This central bank has a dual mandate, and those mandates would go in the opposite direction.
A rock and a hard place, and somewhere in between. Francis, appreciate your time, as always. Francis Donald there of RBC. Up next on the programme, Sarah Hunt of Alpine Saxon & Woods. Former Deputy US Trade Representative Sarah Bianchi will catch up with Sucharita Kadali of Forrester Research and George Saravelis of Deutsche Bank on the latest in Europe. From New York City this morning, good morning. The second hour of Bloomberg Surveillance. Up next.
In case you missed it, on Bloomberg Open Interest.
11 years ago, I bought a Bitcoin on this set.
It was $800.
Yeah, $800, but I spent the Bitcoin on beer and groceries and gas and video games.
And
I wish
hugs.
I had kept it. I wish I would buy a Harley today if I had.
Yeah, but you
probably
wouldn't be a TV anchor, and you probably wouldn't still be on this set. And what a joy that is.
I'd be my feet in the sand and the beer in my hand.
Don't miss the next Open Interest.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people are optimistic about then. The fact is we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. You know, in the meantime, some people who care about this issue are really out, you know, trying to think, do we need permitting reform? You know, do we find, what new ideas haven't we found yet? You know, how do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely.
To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
If it's a short-lived tariff war, then we can expect to see more pressure on fiscal.
This does reduce the growth shock, the upside to earnings.
The lesson from before was that the growth effects are large or can be large, and that would tend to dominate any one-time increase in the price level.
I do think that the growth hit would be significant.
I see something like an extra half point on inflation. And if you go from 2.5 to 3% inflation, that's a big difference for the Fed.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, and your day ahead looks like this. You'll get some earnings later after the closing bell. Those earnings drop from Alphabet. Look out for that. You'll get some economic data as well later on this morning. Jolts, job openings, the big one to watch, and some Fed speak just throughout the trading day. Look out for all of that too. The tone you get from the Fed speak right now, and we'd heard from the likes of Collins, from Goolsby, from Bostic, I think the tone you get from all of them is wait and see. We're not going anywhere anytime soon.
So what are they trying to communicate? And this actually is a really important point. What is the scenario analysis for? We have no clue. You have no clue. We have no need to move. So what's the big deal? This, to me, is going to be one of the biggest tests. Do they lay out some sort of plan for how they will respond to specific incoming data one way or another?
I'm not sure what you do. And if a data point is a tariff, what do you do with that? How long is the tariff going to last? Does it even go on? We talked about Chairman Powell. He was waiting for the administration to articulate the policy changes. They did over the weekend. Then they didn't happen. They backed away. Yeah. If you meet, let's say these tariffs do happen, and they meet on March 19th, I believe, March 18th, 19th, and they last for like 2-3 weeks, and they've got to put out forecasts, and they've got to base those forecasts on tariffs that have only just got on and might not last that long. That's very, very difficult to set policy for.
Which is the reason why I'm looking more at JOLTS, job openings. I'm looking more at just how tight this labor market is, to Francis Donald's point about how much we're trying to bring jobs home, and we don't have people to fill those jobs. I'm also curious about what the outlooks from different companies and their earnings look like. Are they retrenching some of their investment? Is there any kind of hit to confidence, or are people saying, look, we have a president who wants to move fast. He might break some things, but it's a pro-growth agenda, and a lot of this is on the right direction.
We should all want them to succeed. I want them to succeed. I hope this goes well. I want to see that confidence translate into economic activity. And I'd be worried at this point about whether that confidence gets damaged and you don't see the hiring decisions, you don't see the investment decisions, which is why, like you, listen to the corporate earnings. Are they making those calls, or are they getting rid of guidance because they don't know what to do? Look at the economic data. Job openings going up because people want to attract that talent, or are they worried about putting positions open and closing them because they don't know what's going to happen in the year ahead? They're two unknowns. That's how uncertainty can weigh on activity. That's the price of all this uncertainty, and there is a price, even if you don't deliver the tariffs.
And we saw that from Diageo, although it is a United Kingdom company, and the uncertainty there is a lot greater, the potential risks are greater. In the United States, there's another risk also, which is the dollar strength and how much that starts to weigh on some of the corporate earnings at a time where there is not that offset of some of the tax incentives and some of the other pro-growth agendas.
We put it quite simply. Are we going to see a policy mix here? And I stress policy mix because tariff is only one part of the story. That's trade. You need to wait for tax cuts as well and other initiatives too. Are we going to see a policy mix that attracts capital or pushes capital away? And when you speak to investors in America at the moment, they will tell you still that not much has changed on that front. We're looking for a policy mix that will attract capital and not push it away. And I think we're still just about there. What I don't want to see happen is for us to go somewhere else.
There is a statute of limitations for how long the uncertainty and some of the tit for tat can go on before people start to look for alternatives. That's the big argument for gold and the reason why a lot of central banks have been investing in gold. The real tell is if the dollar weakens and yields rise in the U.S., that's game over, and that's what I think a lot of people want to avoid.
And right now, no stress.
No stress.
No real hysteria at all. Away from foreign exchange, to your point earlier, equities are still around 6K. On the S&P 500 this morning, we're still down by only 0.1%. Coming up this hour, we'll catch up with Sarah Hunt of Alpine Sachs & Woods as Wall Street tries to catch its breath. Former Deputy U.S. Trade Representative Sarah Bianchi as China hits back, and George Saravelis of Deutsche Bank on a volatile FX market. We begin this hour with stocks lower as investors are whipsawed by trade headlines over the past few days. Joining us now from Washington, D.C., Bloomberg's Anne-Marie. Anne-Marie, the hardest question, what's next?
Well, I think what comes next is Europe, and President Trump made that very clear once again in the Oval Office yesterday, complaining yet again about things like autos, things about food. He's saying that the European Union doesn't accept them. Well, they do accept them, but it's a very high tariff. When you want to look at some of the grievances Trump has, just compare it to the numbers. On average, Jonathan, when you're looking at goods going from the United States to Europe, there's a 3.9% tariff, vice versa. Goods coming from the European Union to the United States, on average, 3.5%. Not a huge gap. Look at something like the auto sector. We are talking about a pretty massive gap when you look at European Union cars coming to the United States. I believe it's about 10% in that double digit, while it's a little more than 2% going in the opposite direction. On average, a little bit more than 3% on those tariffs when it comes to things like farm products. So when it comes to Europe, it looks like the president wants to level the score. We don't know yet what he plans on doing. We don't have a timeline, we don't have a scope, but look at his grievances and look at the numbers. And that, I think, can lead you to what's coming next. And he said when it comes to the European Union, he said it's been a, quote, atrocity. And I think that's where he plans to take aim.
Anne-Marie, this sounds like an esoteric question, but it matters a lot in terms of what deliverables Europe can really provide to alleviate some of the tensions. What provision will this president use to impose tariffs on Europe? Will it be the same provision of national security and fentanyl that he used for both China as well as Canada and Mexico?
Probably not when it comes to the European Union, although I mean, you can argue that a lot of things could be put under national security issues. We've seen that with this administration. We've seen that with the prior administration when it comes to Biden. But look, they use a number of provisions in Trump 1.0 to go after Europe. Remember, in the first iteration of Trump, for a brief period, there was 25% tariffs on luxury goods, on French wines, on Italian cheeses. You start to think now it sort of made sense why Bernard Arnault showed up to Donald Trump's inauguration. And that is an individual who said he welcomed the new U.S. administration. But when he said that, he also had a caveat and said, we're looking forward to a 15% corporate tax rate.
He's got some champagne to sell, Anne-Marie. You know that. Anne-Marie in Washington, D.C., thank you. Napa's got some great wine. You know,
wow.
I'm going to do that on behalf of...
Wow, I'm impressed.
Yeah, they've got some great wine.
Yeah, one that rhymes with Lopez.
Yes, precisely. Precisely. Okay. Yes. Enough said. Sarah Hunt of Alpine Sachs & Woods joins us now for more. If all of Wall Street's horses and all of Wall Street's men can't put the globalized economy back together again, how do we think about where best to allocate assets? What a question. Sarah joins us now for more. Sarah, good morning.
Good morning.
I'm not going to talk about red wine from Napa as much as I'd love to. Let's talk about this. The policy mix that we're going to see from this administration, does it attract capital or push it away?
I think that that's the million-dollar question right now, and it's certainly something that's been talked about for the first week in a way that it wasn't talked about in the first Trump 1.0, right? There wasn't an argument about capital then, and I think that what we're going to see is what we've seen so far, which is, you know, going this way, going that way. There's going to be a zigzag back and forth, and I think it is hard to pin those things down. So I don't know what the answer is yet, but the big fear is that it does have a negative effect on capital.
The consensus view seems to be that this is still a pro-growth administration, that it will attract capital. The S&P 500 is still around 6,000, but there has been some damage done, particularly to the automakers. How investable do you think certain industries are with this cloud hanging over them?
Well, the tough thing for the automakers is that that's a tough industry anyway because it's so capital intensive and things change so fast. So I think that there is, I mean, you obviously have seen on the semiconductor side, those stocks have not really recovered, even though the market seemed to recover some of the issues from the DeepSeek. So I think that there's a variety of different things going on at the moment, and people will start to have more enthusiasms or less either for different sectors or different areas. But I think that this adding into the tariff thing absolutely puts, you know, a little bit more of a question mark on going too deep into anything without recognizing that there's possible issues that are coming.
We started the show with Steve Chivarone of Federated, and he came on and he does his typical Monday morning, although it is Tuesday morning. He did his typical, look, just hold your horses, look at the fundamentals. There are a lot of good things going on out there, and he's generally bullish, and he's looking to buy on the dips, whether it's semiconductors or some of these other spaces that have been disrupted by tariffs. At what point do you agree with that?
Well, I think that there have been already areas where you have reasonably good value. I mean, the discussion prior to a lot of this was that the S&P equal weight was going to start to catch up to the S&P because the S&P was so heavy in those top Mag 7 names. And so I think that there are areas where you can look at the valuations and go, you know, this is completely reasonable. You know, you look at things like some of the materials, some of the food stocks have gotten absolutely crushed. There are a couple of different things that we like in that area that have good dividend yields and reasonable valuations, 10, 13, 14 times earnings. That's not crazy given where the S&P is right now. So there are obviously areas that you can look at, but it is definitely more of a nimbleness, and you have to be watching things much more closely.
We've seen the NASDAQ underperform pretty considerably, and tech stocks in general for the past more than a month, actually. As you mentioned, they really haven't recovered. At the same time that you have seen this broadening out, yesterday was instructive in terms of what stocks would get most beaten up as some of the trade tensions really picked up. It was the small caps. So how much does the tariff talk threaten the broadening out that a lot of people have been hoping for?
Well, I think that it's, I mean, yes, you're going to get those reactions, and then you have to see where that data comes in. And your discussion earlier about the Fed, I mean, to the extent that they may not want to do anything, this sort of gives them cover not to do very much for some period of time as they sort out what's going on. It really is going to depend on where the economic data go, and that's going to matter for the small caps enormously, as well as interest rates. And I think that that right now is one of those vulnerabilities that's an economically sensitive area. Not that the rest of the market isn't economically sensitive, but it's more so and it's more attuned to what's going on in the U.S. economy. So I think for those companies, what really matters is how things are going on the earnings and the economic front.
At that point, there's a real important message coming from the bond market yesterday, where we didn't see a huge rally in the 10-year yield. We didn't see a huge sell-off either from some of the inflationary impacts of potential inflationary impacts of tariffs. What was the message to you? Was there one, or was it just people paralyzed because they had no idea how to game it out?
I think yesterday was, it's interesting because I think that yesterday the equity markets obviously had a big reaction in the morning, but I think that there was some of a wait and see attitude about where is this really going to go by the end of the day? Because we know that there is the possibility, I'm having phone calls, so that's telling you there's a possibility for this not to be as harsh as it sounds at the get-go. So I think that on the bond market, people were more waiting to go, we're not really sure which way this is going to go. And it's until, you know, if it had gone through to today and nothing had changed yesterday, I think you would have seen a bigger reaction. But I think because that reaction was muted within the same day it changed, I think that gave people enough time to go, it's okay, we can wait before we make any major decisions.
I won't debate how much moved, but I think on this stress test, I think we could take something away directionally from what happened. The fact that yields dropped back at the long end and didn't rise. There's something to be said there. B. Moseley and Lincoln made that point. We discussed it earlier. There's certain parts of this market, certain investors have begun to talk about the growth risk associated with tariffs and not exclusively the inflation risk.
And Francis Donald mentioned that it would take about 1% off growth in the U.S. if some of these tariffs had gone into effect. I think you're right. on the long end, the fact that you saw a yield curve flattening, it shows that people have a very clear sense of what kind of disinflationary hit it could have over the long term.
I don't know what these tariffs would do. We've talked about this repeatedly. By definition, the importer pays the tariff. How the cost gets distributed is going to depend on what the goods are. I know this, though. You can't replace Ferrari. Ferrari coming out with earnings moments ago.
Oh, boy.
Okay?
Oh, boy.
Sales rising 14%. 1 in 4 vehicles sold, guess where? In the United States. The stock is up this morning by a little more than 3%.
You can't replace Ferrari, but some of us can't afford it. So it would be really nice to, you know, share it once in a while. Let me have the keys.
I mean,
it's like, obviously, you know, you can enjoy it. I can't.
Not many people can afford
know,
Opus One either, Bravo.
I know. But, you know, it's sort of the perception is, you know, that it's a really wonderful car. And I just wonder if any of this will dent that perception.
Yes, agreed. Good to see you, Sarah. Thank you.
Good to be
As
here.
always, Sarah Hunt there of Alpine Saxon Woods. That stock is high. The broader equity market's just about unchanged on the S&P. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hacker. Say, Yahara.
Hi, John. President Trump is holding talks later today with Israeli Prime Minister Benjamin Netanyahu. This will be the first visit by a foreign leader to Trump's White House. The talks are set to determine the next phase of Israel's war against Hamas. The two leaders are expected to hold a joint press conference around 5 p.m. Eastern. Meanwhile, shares of Diageo are falling in London trading. The maker of Johnnie Walker, Kettle One, and Casamigos is scrapping its sales target as it deals with sluggish growth and a possible tariff battle with the U.S. About 45% of Diageo's U.S. sales are from products made in Canada and Mexico. And most city employees can continue to work from home at least 2 days a week. The Financial Times is reporting that CEO Jamie Fraser is keeping the hybrid work schedule, saying the policy could be a competitive advantage. That's your Bloomberg Brief. John?
Yahara, thank you. That's one way of attracting talent, Bramo. You go hybrid when the rest of Wall Street's saying, get back to work.
That's one way to attract. That's one way to attract people. The other way is to offer them rides in their Ferraris, which also is a hybrid way of doing that. So if you want to do that, go for it.
Or a stock that's going up a lot.
Yeah,
you know that helps too. Compensation ultimately.
Well, yeah, that's true.
It's not going to be hybrid that gets me.
It's going to be just that the stock is going up and you're getting paid well. Yeah, but it could be a perk.
Maybe. Okay. A debate for another day.
Do you want to work from home for a couple days?
Twice a week.
Twice a week?
Twice a week.
Yeah.
In the bedroom. Just wake up, put one of those plasma TV screens behind me, just sort of sit up. Might be doing it right now. You don't know, do you? It's the future of technology.
I know.
Yeah, sure. Up next on the program, I hated working from home for what it's worth. Tariffs for national security.
He is taking extraordinary steps to do something to tackle the #1 priority, which is addressing the illicit flow of fentanyl and illegal immigration, and he is willing to take the punch.
That conversation is up next. And how much of a punch did we just get from China? Not much of a punch at all. From New York City, this is Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
So no drama this morning. Stocks just about unchanged on the S&P 500. In the bond market, yields are just a touch higher, up by 2 or 3 basis points. Some important economic data later on today. You'll get the JOLTS job openings ahead of what we've hardly talked about so far this week. Payrolls just a few days away. Payrolls coming up on Friday. Under surveillance this morning, tariffs for national security.
This is the first time that a president has invoked tariffs on the basis of a national emergency. What you're seeing play out right now is the president's emphasis on border security. And he ran, of course, on the border and on inflation. And he is taking extraordinary steps to do something to tackle the #1 priority, which is addressing the illicit flow of fentanyl and illegal immigration. And he is willing to take the punch.
So here's the latest this morning. President Donald Trump imposing 10% tariffs on imports from China and calling on the Communist Party to do more to stop the flow of fentanyl across U.S. borders. China opting for a measured response, enacting a 15% tariff on energy imports and targeting a handful of U.S. companies. Anne-Marie joins us now from Washington with a special guest. Good morning, Anne-Marie.
Good morning, John. That's right. I'm joined by Sarah Bianchi, who's a former deputy at USTR under the Biden administration. She now is head of international public policy at Evercore ISI. Sarah, thank you so much. It's been really an incredible 24 hours when it comes to Trump and it comes to tariffs. What happens next? What are you watching?
Well, obviously the Canadian and Mexican skirmishes are on pause for now while they continue negotiation for the 30 days. I assume they will continue to make progress. I don't expect to see across-the-board tariffs on Mexico and Canada. I do expect ultimately they will pivot into a broader conversation about trade and USMCA. China, well, we're just getting underway on that one. I think Beijing did, need to look strong in responding back, although it is a measured response. That one could go on for a while. There's a lot of complexity in that relationship and a lot of things to work out.
Yeah, when it came to China, John called it a pinch, really not a punch. It seems almost like a warning shot. But given how Trump reacted with Mexico and Canada, got on the phones with both those leaders, he's teasing out this potential call with Xi Jinping. Do you think there's a chance that they could walk these back as well, claw back these tariffs when it comes to China?
Anything's possible, but I do think it's less likely. And regardless, I do expect this year we're going to see higher tariffs on China that are lasting. I expect the administration to go back to its initial 301 investigation. I expect there to be a lot to say on export controls. So maybe he pulls back briefly, but I think it's much more likely these ones stay in place.
Okay, so Mexico and Canada is a bigger discussion, potentially the end goal about USMCA. Maybe Trump wants to enact more when it comes to that trade agreement. China, this is going to be a long battle. Europe. What happens with the European Union? Trump was once again in the Oval Office listing off these grievances and told the world they're going to be next.
Well, Trump has always had a lot of issues with Europe, and I do expect that here, Trump uses tariffs for all sorts of reasons. He uses it for leverage on other matters. He uses it for retaliation, for reshoring. With Europe, it seems to be about a couple of things. One is other issues that he cares about. Buying natural gas from the United States, participating in NATO. But he also has grievances about unfair tariff rates. So the tariffs coming in on U.S. car exports are higher going into Europe than when they come here. There's a lot left to discuss about steel. So this one's going to be multifaceted, and I think will take time.
What do you tell your clients to prepare for this kind of environment we're dealing with?
Well, I think you have to watch each time what exactly is Trump solving for with this particular issue. And I think this one was very, very clear that it was about immigration and fentanyl and that he wanted concessions there. That made us think that it was easier to resolve. Also, when he does things permanently, we don't tend to see across-the-board tariffs. We don't tend to see him hitting the auto industry or the gas industry. So on those kinds of ones, the off-ramp is a little bit easier. When it comes to things like strategic sectors for China and Europe, there you have to watch a bit more of a balanced negotiation that's ongoing between experts and potentially more lasting tariffs in place.
We're still waiting for the head of USTR to have his hearing to be confirmed. That's going to be Jamieson Greer. How do you think he's going to approach all of this? Is it going to be under 301 and his portfolio, or will Trump try to use IEEPA, 232? How is he actually going to enact this tariff agenda?
Well, Jamieson Greer is a really good guy and very knowledgeable about all of the tools for trade. So I expect him to use all of the above. Even though IEEPA is not the USTR's authority, I think in certain cases he will argue for that. On China, I expect him to look back to the 301 that the Biden administration, the Trump started, and then Biden kind of re-upped to reopen that conversation, 232s. But again, like Lighthizer, who Jameson worked for, he is very, very knowledgeable about all the tools and also about all the relationships and some of the stakeholders who are going to come in on any particular issue. I think he'll be a very helpful addition.
I call him Mini Lighthizer. Robert Lighthizer, Ambassador Lighthizer, is not part of this administration, but this is probably for the Trump world the next best thing, that individual who was really trained under him. When it comes to China, Jamieson Greer in the past has said that we should be decoupling. Do you see that the direction of travel for the Trump administration, or do you think Trump actually wants to be more nuanced because he wants a deal out of Beijing, whether or not it's with autos or whether or not it's with China putting the thumb on Putin to strike a deal in Ukraine, or potentially something like TikTok?
So it's very interesting. I think that we are going to see a lot of transactions between the Chinese and Trump around issues that you mentioned, TikTok. But whether or not we have some kind of grand bargain that addresses all of the issues that the United States has with China right now, particularly around export controls and really complex technology, I think that's a little harder to see. I don't think that Trump himself or his people feel particularly reassured that China delivered on the Phase 1 agreement last time. I think all evidence is to the contrary. And there is a lot of concerns around technology. So where I see that we are going to still see this decoupling in sensitive areas, maybe not across the board as Jameson might want. And I do think that leaves some opening for deals. But I think there's a lot of complex things that have to go right. First of all, I really do believe President Trump is very interested in resolving this TikTok thing. He sent a message to a lot of people that he's on the ball for that. So that's
all the time we have this morning. Thank you so much for that, Sarah Bianchi. Jonathan, she was in the room in the past, former USTR deputy under the Biden administration. One thing pretty clear from that conversation, this is just the beginning.
Anne-Marie, it's set to continue. Appreciate your time. AMH down in Washington, D.C. Up next on the program, we'll catch up with Sucharita Gadali of Forrester Research on the retail and supply chain outlook as trade uncertainty lingers.
is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Equity futures just unchanged on the S&P 500, 2 hours away from the opening bell with your morning movers. Let's cross over to Manus Cranny. Good morning, Manus.
Jonathan, good morning. Dan Ives said the Palantir press release was so good, you want to print it off and shove it in the Louvre. There you go, up 22%. Two-thirds of their business comes from the government. Doge for them, with Elon Musk, it's like manna from heaven for them. They basically say that. It's a windfall for them to come 22.3%. I love this. Untamed organic growth. It's like unbridled exuberance in this stock. Commercial sales in the US for this year, going to be up 54% at over $1 billion. They're in a new phase. That's the CEO's line. Bank of America has a price target on this of $125, 43% as of the close last night. So we've done 20% of that, or 50% of the move so far. Spotify. This time last year, the headlines were Joe Rogan re-signs for $250 million. They spent $1 billion on podcasts last year, and that's what irked the market last year. We're up 10% this morning. Premium subscribers, they are rolling in quite nicely. In that back quarter of last year, they added 35 million users. That's the best fourth quarter for them ever. And they turned a profit, 367 million. So this is about raising your subscription prices. Are you still on the free version, Jonathan, or have you paid up and looked large? Close it off with Estee Lauder. This is about the reality of change costs. Costs $1 billion, costs nearly 7,000 jobs, and your net sales for this quarter are going to be down by about 10%. Why? Because the travel in Asia is lower. The duty-free sales are under pressure. Consumer sentiment in China and Korea under pressure, and a double-digit drop in those global travel duty-free. For a paraphrase, duty-free is where the real pressure is on this. Change costs money. Are you on the free Spotify?
I'm paid up, Manus Cranny. You know that. I hate commercials. You don't want to listen to music and get it interrupted by a commercial, do you, Bremo?
I've done that.
Really?
Yeah, I have. I have to be honest. Yeah, exactly.
You've not paid up?
No.
Okay, you're in the gym.
Okay.
Okay, last set, big push, last 5 minutes of the workout, and then a commercial kicks in.
I know, that's why I listen to podcasts. It's true, and it's to get around that rather than just pay it, which is just the obvious logical thing. I don't want to be having this conversation on TV. I don't know why I'm being so honest.
Yeah, all right. Okay. I'm going to pay it for you, all right?
I'll pay it. I'll pay it tonight.
Under surveillance this morning. China retaliating against President Donald Trump's 10% tariffs with levies of its own. Beijing slapping a 15% tariff on just under $5 billion of U.S. energy imports and a 10% fee on oil and agricultural equipment. China also adding at least 2 U.S. firms to a blacklist. This is the pushback, if we can call it that, from the Chinese side.
This is the smallest amount to save face while not actually inflicting any damage. Oh, and guess what? This goes into effect on February 10th. They're supposed to talk today, so maybe it could be rolled back. There's a larger question of what this trade skirmish looks like. It won't look like Mexico and Canada. This isn't going to be something that you can very easily placate with a couple of measures and orders that already were going into effect. That's what I think people are looking at.
So China's playing the long game. I think the United States is as well. I don't think we should confuse short-term goals with long-term objectives. The U.S. administration under Donald Trump has already got some concessions from certain countries. That's good. Step one. The long-term objective, though, is still the same. This president wants that manufacturing production to come back to the United States of America. Now, we can have some debate about the best best way of doing that, or whether it can even be done. But that's the goal. That's the objective. BMW's factory in South Carolina, in Spartanburg, they want thousands of them. They want more of that. And they think the best way to do that is to put the walls up and tell people you can't export into us anymore. What you need to do is invest and build a plant here, and then I'll drop corporate taxes for you. I'll make the economy a fantastic place to invest, not export to. They're two very different things.
China also has a very different type of parameter than, say, Mexico or China or even Europe. Is the U.S. really going to say, we want you to come build your factory here and then send all the data back? There is another national security overlay that makes this conversation much more complicated, which goes to TikTok, having to do with who might be owning it.
It's deeply complex. Let's talk about TikTok. President Trump signing an executive action, he says, would direct officials to create a sovereign wealth fund for the United States. The Treasury Secretary, Scott Bessent, a Commerce Secretary designate, Howard Lutnick, likely to lead the effort. Trump suggesting the fund could be used to facilitate the sale of TikTok. We've heard rumors of this over the past few years.
There are a lot of questions here. Where are they going to get the money? If it's a sovereign wealth fund, is it going to come from oil and gas the way that it has in Norway and some states in the United States? Then what are the parameters around what they can invest in? Is this a matter of just investing in, say, pharmaceutical companies that you're buying syringes and vaccines from, or is this some kind of strategic fund that can be allocating in a very specific way to try to gain money? Then there's a question of who's going to run this. It's the Apollo Global Management co-founder Leon Black's son is going to run this. There's a lot of questioning here that needs to be evaluated. At the same time, it's actually an interesting idea, and it's one that actually Biden had a similar thought too. So you can't dismiss it, but a lot needs to be determined.
Do you remember the original deal, the original TikTok deal? And this should be on like those quizzes you do at the end of the year, and you should ask the staff if they remember the original TikTok deal. Wasn't it Oracle and Walmart? I think it was the two of those companies. And I think at the time the president made the point that he should get a cut. The Treasury should get a cut for brokering that deal. Is that where this is going? Does that even work?
That they're going to get a cut from it? No, it doesn't work. And where are they going to get the money? Are they going to borrow it at 4.5% and then invest it? Is it going to be a hedge fund? Is it going to be something that's going to be raised from certain levies? Is this going to be where all the tariff money is going to go and then get invested in TikTok's potential acquisition by somebody else?
That could work. That could work, potentially, sure.
Okay.
That could work.
We're giving free ideas here.
We'll see if that does work, if that's the way they move forward. Elsewhere, Israeli Prime Minister Benjamin Netanyahu set to meet with President Trump in the Oval Office at 4 p.m. Eastern Time. The two set to discuss the ongoing truce in Gaza, which Trump's Middle East envoy has indicated he wants to make permanent.
There have been a lot of changes going on with Israel, given the fact that the hostages have come back. There's a hope among a lot of people in Israel to continue with the ceasefire, also in Gaza. Big questions around who potentially could come into Gaza for some sort of two-state solution. And Donald Trump has been pretty aggressive in saying that maybe they should all move to another country, the people who live in Gaza. There has been so much pushback to that and a lot of anger on the part of allies in the Middle East toward the United States. Nonetheless, this goes to the idea that in Israel, a lot of people think that Trump is responsible for the ceasefire that has gone into effect. How can he push that forward at a time where there still is a lot of complicated negotiating that has to happen?
It's week 3. I think it's important to keep counting. Only week 3. It's kind of amazing, isn't it? The third week of the U.S. administration.
Another year?
The to-do list is very long. A lot of people think that the previous administration did not get enough done, particularly in this region. The to-do list is very long, and I think they're only just getting started. Obviously, we've got 4 more years to make a real change. Equity futures then just about positive here on the S&P, but I think we can call it just about unchanged. I want to turn back to trade. Retailers bracing for the impact of President Trump's tariffs. Sucharita Gadali of Forrester Research writing, tariffs will inevitably hurt US GDP. The sectors most likely to be impacted are electronics, toys, and some components like plastics, which are in nearly all of our consumer goods. Sucharita joins us now for more. Sucharita, welcome to the program. I'm actually more interested in what happens to some of these Chinese retail players that have been selling into the United States at really, really discounted levels that won't be able to get certain breaks anymore. How much of a change are we going to see with that so-called de minimis exception? How much does that change?
Well, there is the executive order called for the tariffs on all goods. So that assumes that the de minimis exception is going to be eliminated. And also you combine that with the Congressional Budget Office's call for getting rid of those exceptions too. There's no question that that is not a good thing for players like Temu, Shein, even TikTok Shop, particularly if they are selling from the Chinese sellers in overseas. This is not a surprise, to be honest. We have been talking about eliminating the de minimis exception for a long time. So this should not be a shock to sellers. This should not be a shock to consumers. But yet everyone is acting as if this is some new thing. My hunch is that some of those sellers may have already started to divert some of their goods to other regions so that the shipments aren't labeled as coming from China. So that's a way to circumvent it. Not something that I would advise, but likely happening. And otherwise, there will likely also just be some demand decreases or just some compression in any profitability, because some of these companies are absolutely going to have to absorb those differences in prices.
It's something that Gita Gopinath has talked a lot about at the IMF, the idea that when you put tariffs on, you put obstacles, just more gets funneled through Thailand, through Vietnam, through Malaysia, through the Philippines. And we've seen that with increasing volumes of imports from the United States, from those regions into the United States. How much do you expect that to accelerate the more that tariff talk continues?
In the short term, it will likely accelerate a lot. But in the long term, the United States is going to have to figure out how to reduce some of that diversion. And that can be through imposing tariffs on some of those regions of the world as well, or doing a better job just monitoring what is coming in. In this age of AI and camera vision and being able to automate more things, there's really no excuse for not being able to better track what comes into the United States through the ports. But yet there still seem to be claims that it is incredibly onerous and difficult to do. So I would probably allocate more funds to trying to figure out how to better monitor what is coming in versus some of the expenses that we're already doing that are not necessarily the most effective use of some of our artificial intelligence solutions that are out there.
John and I were talking earlier about how the ultimate goal of a lot of these tariffs, there are a number of the goals, but one of them is to increase production back home, bring it back home to the United States. How realistic is it for some of the retail companies to concentrate production in the United States and bring it back at a feasible price?
Well, in some cases where you can have a heavy degree of automation, it may actually be fairly viable. You see that in the automotive industry where there are factories that are producing goods, like, for instance, BMW, as was mentioned earlier. And they're able to do that if there is a heavy amount of automation. For those categories, like, for instance, perhaps apparel, where they're still very, very manual, that may not be realistic. And we're talking probably more about nearshoring to other regions that are closer to the United States. I think that really there are a couple of things with China. One is that there are geopolitical issues related. Oh, sorry. You can't hear me still?
No, we can hear you.
Okay. Yeah, so there are issues that are related to concerns around Taiwan that are related to China. But in the case of Canada and Mexico, I think what is really there is about improving the number of exports so that the balances of trade are not as skewed, so that our American companies are able to export more. So I don't think it's necessarily about bringing manufacturing back, but increasing the manufacturing of the companies that are already sending to those regions.
Sucharita, there was a theory before some of this started that the biggest companies would have the easiest time negotiating new contracts, navigating through supply chain disruptions and rejiggering. Do you think that's still true, that the Walmarts of the world, that some of the biggest retailers will do better than, say, smaller ones?
Likely that is true. Certainly the bigger companies have the ability to move their production to different parts of the world. But there are a number of multinational companies that actually have very, very heavy presences in China. And they are absolutely nervous and trying to cut out different exceptions to some of these tariffs. That could be companies like Apple, Starbucks, even Tesla. Certainly the casino companies, which have a significant percent of their revenue coming from Macau. So there are a number of different players that absolutely want to see these situations resolved. And regardless of the level of negotiation of physical goods, they are still dependent on either Chinese manufacturing or Chinese consumers. And that puts them in an extremely vulnerable situation. So it's a complex story. There are companies that are going to be winners in all of this, and there are companies that are not going to win because they made bets on China that were decades ago that are going to be very, very difficult to unravel.
Everybody wants a carve out, that's for sure. Sucharita Kothari there at Forrester Research. Sucharita, thank you. Thanks very much. Howard Lutnick sat in this chair just to the left of me a number of months ago. That's the Commerce Secretary Designate. Do you remember? Will there be carve-outs? And he said there will be no carve-outs. Now, of course, since then, Donald Trump has won the election and he's been nominated to be the Commerce Secretary. I'd love his thoughts on that now. Will there be carve-outs?
So far, there have not been carve-outs. It's very early in this process, and as the China wars start to heat up, that might be a different one down the pike.
Yeah, Diplomat Kirk is going to dial 1-800-White House.
On his iPhone.
Yeah, probably. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hacker. So, Yahara.
Hi, John. El Salvador's president offered to accept convicted criminals of any nationality, including American citizens, and house them in a mega prison for a fee. Secretary of State Marco Rubio praised the offer as unprecedented without saying whether the Trump administration would accept. Meanwhile, Spotify shares are rising in the pre-market, up nearly 10%. The company posted better than expected subscriber growth and its first ever annual profit. Spotify shares rose more than 135% last year as the company's CEO prioritized profitability after years of expanding into audiobooks and podcasting. And Salesforce is cutting more than 1,000 jobs at the same time it's hiring workers to sell new AI products. That's according to a person familiar. The company is focusing on maintaining profit margins after pressure from activist investors last year. Salesforce is expected to report earnings at the end of this month. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, Europe in the trade crosshairs.
The European has abused the United States for years, and they can't do that. And they want to make a deal. Let me tell you, in all cases, they all want to make deals.
Up next on the program, George Saravelos of Deutsche Bank on the volatility in this FX market.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together. And that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just you're singing?
No, I'm spoken word.
You're spoken, sorry.
My voice and my conversation, my poetry, you know.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Stocks and bonds just about unchanged. We're going nowhere on the equity benchmark on the S&P 500. Going somewhere in the bond market, kinda. Up 2 basis points on 10s, the 457. In foreign exchange, the euro negative again, down 0.1%, 103.26. And a surveillance this morning, Europe in the trade crosshairs.
The European has abused the United States for years, and they can't do that. And they want to make a deal. Let me tell you, in all cases, they all want to make deals. There's nobody that doesn't want to make deals. All we want is a fair deal. And you know, there's a word reciprocal. I'd go right now, reciprocal tariffs on everybody. Well, they charge us tariffs. The European Union has a VAT tax, which is through the roof.
So here's the latest this morning. EU leaders scrambling to avoid their own tariff war with the US as President Donald Trump threatens to slap levies on the bloc. George Saravelos of Deutsche Bank saying euro-dollar is at risk of parity, writing the drivers of euro-dollar can be broken down into 2 parts, relative monetary policy and a tariff risk premium. George joins us now for more. George, welcome to the program. Let's talk about the second part, that tariff risk premium. How big is that?
So, John, I think it's the key question for the next few months. And on our end, we're not spending much time trying to predict what President Trump will do. I think the experience of the last few days has shown it's not a very fruitful exercise. It's all about trying to figure out what the market's pricing and therefore the risk distribution around events. And when we look at the so-called tariff risk premium, and you can see it in many different parts of the market, you can see it in the US inflation curve, you can see it in the deviation of the dollar from fair value, you can even see it in what's known as the EFP in COMEX futures for gold. When we look at all these tariff metrics, they've been sending a consistent message that the market's pricing a very limited tariff risk premium. It again tried to price more yesterday. It's now reverted back. But it's precisely because that tariff premium is still quite low that we see the risk distribution skewed towards essentially pricing in more tariffs if and when they materialize.
George, is that just the euro, or can you say the same thing about the Chinese currency?
I would say it's across the board. If you're looking at all global markets, whether you're looking at fixed income and the so-called inflation hump that's priced into break-evens, it is still, that inflation hump is still very low. It is definitely valid for the dollar. When you're looking at the euro, for example, when we mention parity, that is not a forecast, so to speak, that's set in stone. It's just that if you get a reasonable outcome in terms of tariffs around the midpoint of the range that's being discussed, that's where we'd get to. Of course, if you get even worse outcomes, it could be bigger. China is more difficult because this is a policy-determined currency. The market is not free-floating. And I think this one is where the specific policy choices by the authorities will play a much bigger role.
George, you talk about the trade war risk premium, and that typically has been strong dollar. We've been talking on the show about at what point the hangover effect of the tit for tat of trade negotiations, trade wars, ends up with the rest of the world trying to withdraw money from the United States, not put money into the United States. How much and how closely are you watching? What indicators to maybe suggest that the appetite for the dollar was starting to wane?
That's a great question, and I think a very important one. So the way we think about it, first of all, is relative economic impact. You have to think about currencies in that way. And the US possesses a number of unique features. It's the world's largest economy. It has the lowest share of trade. It has a big trade deficit, and it's very services intensive. And President Trump, of course, knows all these things. But what that means is that every time tariffs are threatened, it has an asymmetric impact on the rest of the world. And that's exactly why the dollar is strengthening. I think what you would need to see for an unraveling of the inflows you allude to is essentially a big US-centric growth slowdown that's more sharp than the rest of the world, that causes the Fed to become more dovish. And so far, especially given that tariffs are tied in with the fiscal negotiations potentially in a fiscal expansion, we don't see any signs of that.
In the meantime, there is the likelihood, as you said, the disproportionate effect in other countries, that if tariffs do go into effect, or even the suggestion of them will slow economies like Canada, we heard that from the Bank of Canada, or potentially in the European Union. On the margins, even though this is a single mandate ECB, do you expect them to cut rates more aggressively to counteract some of that potential growth shock?
Well, again, the ECB is a huge focus. And to go back to the point around the tariff risk premium that was priced in, up until last week, the market was pricing the ECB to stop above 2, around 2.1, 2.2. Now, if you think about that, that was at the upper end of the neutral range, which Lagarde alluded to, 225 to 175. So our view on the ECB has definitely been more dovish than market pricing. If you take a step back, European growth is below trend. Forward-looking numbers of inflation are pointing at or below trend. You've got a net fiscal stance that's tightening and tariff risks. So we see the ECB potentially cutting down to 150. The market has adjusted over the last few days, but I think, especially versus the Fed, we see that rate differential widening again.
So, George, when you say that, I just want to jump in. I'm surprised that that's even somewhat contrarian right now. It's surprising to me that ECB officials are still talking about neutral and not talking about getting accommodative. When's that going to change?
So it's a very interesting point you raised, John, because the narrative in the market is that the ECB should be cutting more. But I always like distinguishing between the narrative and what ultimately matters, which is pricing. And if you look at market pricing for the ECB, it has been fairly hawkish. It's been above 2. Why has that been the case? You have had some rise in energy prices, and the ECB is sensitive to that. But I think crucially is ECB communication, especially from those hawkish members, for example, Governing Council member Schnabel. And I think what is required to change is for these members to gradually accept that the ECB is going to need more, to do more, and I think we will get that over the next few months.
Hey, George, clinic from you as always, sir, on foreign exchange. Appreciate your time. George Saravelos there of Deutsche Bank on the risk of a return to parity on euro-dollar. Parity, of course, just around the corner. Two-part story for them, relative monetary policy and a tariff risk premium. And the latter surely informs the former.
At a time when you have, in particular, German members looking to maybe keep rates a little higher.
Up next on the programme, we'll catch up with Kevin Gordon of Charles Schwab, Angelo Zeno of CFRA, Greg Dacko of EY, Tony Rodriguez of Nuveen. The third hour of Bloomberg Surveillance, up next.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
In case you missed it, on Bloomberg Open Interest.
11 years ago, I bought a Bitcoin on this set.
It was $800.
Yeah, $800, but I spent the Bitcoin on beer and groceries and gas and video games.
And
I wish I had kept it. I wish I would buy a Harley today if I had.
Yeah, but you
that
probably wouldn't be a TV anchor, and you probably wouldn't still be on this
True.
set. And what a joy that
I'd
is.
be my feet in the sand and the beer in my hand.
Don't miss the next Open Interest.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Doesn't look to me like Wall Street has priced in these tariffs going into effect on a sustained basis.
I feel like the risks are much higher than people appreciate.
The biggest theme is risk off.
You think we're at the beginning of a multi-year move out of the U.S. into non-U.S.
There's so many unknowns. Our approach is, you know what, we expect nothing, but we plan for everything.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Today is just a fantastic example of beating expectations and a very low bar. The headline should be, a 10% tariff on China goes into effect. But the headline that you get on tariffs is actually, we've avoided tariffs on Mexico and Canada of 25%. We're talking about something else when typically we'd be talking about China and that one thing.
Which goes to the point of signal versus noise. And how do you decipher at a time where this is just the beginning? We're what, week 3?
Week 3.
I mean, to me, just to try to wrap your head around that, to understand what the destination is at a time where you're going to hear a lot of potential threats, a lot of potential tariffs and announcements, et cetera, and they could get walked back the next day, or in the case of China, they could not.
They stick. Equity futures right now just about positive on the S&P 500. On the NASDAQ 100, up by 0.2%. Big event for the NASDAQ comes after the closing bell. You'll get earnings from Alphabet. Before all that, you'll get some important economic data. Job openings coming at 10 a.m. Eastern Time, and a sprinkle of Fed speak through the session.
Fed speak is going to be what you expect. We don't know. We're going to have to watch the data. We can afford to be on hold. Okay, park that. JOLTS will be interesting because you get a sense of the actual real economy and just how tight the labor market actually is. But more importantly, this week, you get almost a quarter of the S&P 500's market cap reporting. Alphabet is one of them. Amazon comes later in the week. The earnings calls, how forward guidance can really be delivered at a time where there is that much uncertainty, that I think is potentially going to be the big event of the week.
Very dependent on what industry you're in, but we've seen a few interesting examples over the past week or so. You mentioned GM last week, came out with guidance, people didn't believe it. Diageo over in the UK didn't bother coming out with guidance. In fact, actually had to suspend its sales target. Why? Because of tariffs, couldn't offer any. This applies to central banks too. You mentioned the Fed speak. They can't offer any clarity, if they ever could, about the future. They can't give you visibility. The Bank of Canada in the past week, you were talking about that too. They cut interest rates and basically said there's no point providing guidance. We don't know what's going to happen here. The only thing we can do is provide you some comfort that we're doing what we can just in case it does happen.
And you made the really important point earlier. All of this has a drag on some level if it continues for a longer period of time. There is a feeling that it is a pro-growth type of moment, and yet if you have companies that are unable to make certain types of investments that could potentially get caught up in the crosshairs but don't, does that start to drag on sentiment, and do you start to feel that? We're not there yet, but we did see the S&P 500 not recover yesterday the same way that some of the other currency pairs did, and that is somewhat telling.
The overall policy platform is still pro-growth. The overall platform is still pro-growth. We've talked about this repeatedly through this morning. You want to see that confidence translate into investment decisions. You want to see that confidence translate into hiring decisions. In a few months from now, I want to see job openings up, not down. I want to see decent payrolls growth. I want to see people be confident that unemployment's not moving in the wrong direction. You need to keep that confidence. Don't take it for granted.
I think you should run. That sounded like a really good speech. I want people to look out over their horizons and feel like they have opportunities. I want companies to feel the confidence to go out there and invest. It was good.
I think Kevin Hassett's job's safe at the NEC. Thank you. Coming up this hour, Kevin Gordon at Charles Schwab as markets grapple with trade whiplash. Angelo Zeno of CFRA previewing the latest earnings from Alphabet, and Greg Dacko of EY on the economic impact of trade uncertainty. We begin this hour with stocks lower. The eyes of the world on Donald Trump's next move. Joining us now from Washington, Bloomberg's Anne-Marie. Morning, Anne-Marie.
Good morning, John. When it comes to the next move, I think you have to just look directly to the European Union. He already dealt with Canada and Mexico. Those tariffs were walked back, 30-day pause. We do see both those countries adding more to a robust border security, and also Canada saying they're going to have a fentanyl czar. And the Trump administration is really going out and branding this, that this was for the American people, and really him owning up to what he promised on the campaign trail and doing more when it comes to immigration. The Wall Street Journal says that Trump never admits a mistake, but he often changes his mind, and they say that's what he did yesterday. When it comes to China, though, potentially this is an opening salvo. Those tariffs went into place, and we saw rebuttal from China. Now, they weren't massive, but they were calibrated. Xi Jinping clearly wants to make sure that he's not going to backfire on his own economy. And even when it comes to China, there's this potential for some deal to happen. Maybe it'll take longer, but potentially we could see a phone call as well between Xi Jinping and Trump. And then finally, Europe. We don't know what he's going to do. We don't know when he's going to do it. But this is what we do know. In the past, he's taken aim at Europe. And yesterday, he listed again a number of grievances he has with the European Union when it includes things like cars and farm products. Because when it comes to those tariffs, the gap is much wider than it comes to most normal everyday goods. So Europe is going to be next. That's what he said. We're just waiting on timing and the scope. We're living in an area of uncertainty right now, but we do know that Trump likes to use tariffs, and he's delivering on that promise.
Anne-Marie, we've been discussing whether he's trying to get out of the way some of the less growth-forward types of policies before going into some of the tax cuts and the other deregulations. Do you have any sense of your conversations down in Washington, D.C., that that is the case and the goal of doing all of this up front?
As one person put it to me, Donald Trump is doing everything, everywhere, all at once. So while he wants to recalibrate trade and he wants to make sure he's focusing on the southern border and on fentanyl, and he's using tariffs basically as that negotiating tool, at the same time, of course, there are people in his administration that are looking to Congress and to trying to make sure they can get this tax bill done. But tariffs can happen immediately. We've seen that overnight when it comes to China. It's going to take a lot more work for this administration to work with Republicans on the Hill to get through their reconciliation package. I mean, some members of the Hill are still debating whether or not it should be 1 or 2 bills. They also need to make sure that they extend government spending, and potentially in March, the government could run out of money and we could see a government shutdown. And of course, they have to deal with the debt ceiling. All of that before they get to tax cuts.
Anne-Marie, on the latest in the nation's capital, a steep hill to climb to get all of that done. Kevin Corden of Charles Schwab with this to say, if we are to learn anything from the 1819 trade war, it's that markets do not price everything all at once. We have no clarity in our crystal ball on how this will all play out. Kevin joins us now for more. Kevin, welcome to the golden age of volatility.
Thank you. Nice to see you.
Quite something, isn't it, over the past few weeks? It's only week 3. Do you just stomach the volatility and just accept, believe in the pro-growth platform of this administration and stay long?
Well, stay long in the sense, if you're lengthening your time horizon, yes. Because if you shorten it too much, where you're trying to react to and digest all these day-to-day moves at every single moment, it's whiplash, it's exhausting. It's impossible to do in terms of trying to game out or forecast what's going to happen. But I think that, you know, I think back to when we wrote our outlook for this year, you talk about stomaching volatility. I mean, our view this year, and you're already starting to see it play out, where the dynamic is probably going to be flipped versus what you saw in 2024. 2024 was amazing from an index level volatility standpoint. The max drawdown that you had for the S&P was 8.5%. All of the churn and the scarring that happened was at the so-called, you know, individual member level, where the average max drawdown was more than 20%. But you didn't see that at the index level because it was just happening via rotation all year. Now, you know, not that we're expecting imminently some 20% correction in the S&P this year, but there's going to be probably more of a struggle at the index level, in part because of what we've seen over the past week with some of the mega caps being more of a drag, but also because of the volatility that comes from anything tariff related. I would also argue immigration policy related. But clearly, you know, tariffs have been in the driver's seat. But that makes it a much more challenging index level environment.
If you put a chart of the index up on the screen like we just did, it goes up and to the right. There's no problem there. You wouldn't be able to see that one of the biggest weightings in that index has had a more than 20% drawdown. NVIDIA. What do you do with those kind of names? And I know you can't do single names, but the kind of names, the sectors that are getting beaten up at the moment, does it tell you about where leadership will be in the future? Does it give you any kind of signal with regards to that?
Well, you know, in many ways, we've already had this signal from a sector standpoint. So that stock lives in the tech sector. The tech sector has gone nowhere since last June, which I find remarkable. That it doesn't get talked about a lot. But you know, you're talking about the biggest sector with some of the largest names, which has become a dominant AI theme. It hasn't really moved much, and it's at its lowest since the early November. It's wiped out its entire post-election gain. So you've already kind of had the signal being telegraphed in some ways, where at some point at the summer, probably late summer last year, there was more of this broadening out trade that started to move more into financials, industrials, some of the more commodity-sensitive parts of the market initially, but that has pulled back a little bit. And I find it remarkable that even within a group like the Mag 7, the 3 sectors that are representative, which is comm services, tech, and consumer discretionary, it's comm services and consumer discretionary that have really pulled forward and pulled ahead and kind of left tech in the dust. So if anything, if you're viewing it through the AI lens, I think that it probably speaks more to the fact that there is more to be had and gained from the rest of the market, not just a handful of names, not just one sector. So call it the AI adopters, now starting to catch some of the trade or some of the upside, and not just the AI creators.
I'm going to lean into golden age of volatility. You try to coin it. I think it's a really important thing to talk about. We're talking about volatility at a time where VIX is at 18. It's not actually rising that much. There is, however, every day a feeling that you have no idea what's going to happen. And the peak to trough on any given day is insane for specific names that are huge market caps. What's the hedge here? At a time where there's volatility in specific spots, but overall, maybe things will even out, and there's volatility in the messages and the truths coming from the White House.
I think the hedge is keeping your emotions in check, because this is not just volatility in the equity market.
But go on, yes.
The hedge is therapist. I mean, the volatility is not just in the equity market. Now it's cross-asset. I mean, I think that probably what becomes more dominant, more of a focus in this next era that's dominated by tariff policy and immigration policy and down the line tax policy is in the FX markets. I don't think it's necessarily in the equity markets. And you can see that clearly yesterday with some of the moves. I know you were talking earlier, John, about the huge downdraft in the peso or the loonie, and then the massive upswing. You didn't have that kind of move in the equity market. You still closed down. Of course, you moved off the lows and closed off the lows. But I think a lot more signal is going to come from foreign exchange at this point because of not just the tariffs and the amount and the dollar amount associated with it, but just how much more fragile the global system is and the global backdrop is this time relative to 2018, 2019, especially because now you're talking about two major trading partners and allies, in addition to China. Last time it was really just China. So you add a whole nother layer of volatility associated with that because of who's involved.
Typically, when people are worried about risk, they go into the dollar. Right now, the source of risk is the dollar.
Yeah.
Or not necessarily the dollar, but just the United States and the U.S. policy. At what point does that shift, where the dollar doesn't have the same exact kind of knee-jerk response?
I think that's why the dollar becomes one of the most important, if not the most important thing to watch in the coming years, especially from a Fed independence perspective. Not that we're worried about that imminently as some sort of risk, but at some point you have to imagine that there's going to be a little bit of a friction where if you do have a potential for slower growth, but you also have an administration that really wants lower rates, and you have an investor base that wants lower rates, but you have a Fed that probably can't move as much because there might still be an inflation problem stemming from whether it's a price level increase from tariffs or whether it's inflation coming from the labor market because we have suddenly a lower labor force and lower labor supply. I think that's where there becomes an issue. Not that it is an imminent issue, but I could see that becoming a really dominant problem for the Fed.
Well, let's just finish on that one component of the story then. The bias of the Fed is still to cut interest rates, certainly not to hike. Is that bias to cut interest rates constrained by this? We had some pushback from BMO's Earl Davis yesterday, who said that wasn't the case. The Fed put's still there. The bias is to ease. Do you sense that maybe that bias is constrained somewhat by the headlines we've had over the past week?
Well, I would probably just use Chair Powell's words. I think the three most important words from last week: we don't know. Nobody knows. And that's the tough thing about days like yesterday and now this new era that we're in from a trade policy, trade war, trade dispute perspective, whatever you want to use to label it, is that the fog now is so dense in terms of what this is going to mean for business capex, what this is going to mean for inflation. Because you think about the outcome of this, where you do have potentially aggressive tariffs going in place. Yes, at the outset, that's probably inflationary to some extent, especially if you have retaliation. But again, if we are to learn anything from 2018 to 2019, because that's really the only modern period we have for a trade dispute, it's that there was a meaningful slowing in business capex. I don't know if the fourth quarter, because we did have a slowdown and it went negative in the fourth quarter, as we learned from GDP. I'm not sure if that's a trend that continues, but if you see maybe a stabilization around that zero line for business capex, in addition to sentiment surveys that then start to roll over, that could be a problem for corporate America. It could be a problem for earnings. It's not our call, right away, but I think that's something that needs to be considered more.
When we have these debates, I think we've got to talk about what timeline we're on. If you want to stimulate a domestic supply side response, it's going to take a long, long time. In the short term, people just won't make those decisions. They won't make those decisions until they've got long-term clarity on what's going to happen with policy.
How can you have long-term clarity at a time where we don't have clarity on, 30 minutes from now?
What's going to happen next week?
Exactly. So there is this sense of paralysis, but longer term, it might become easier if there are some longer-term Congress-led types of measures.
I always said that strategists should do a course in psychology because half the job is providing therapy to investors just to stay invested.
Well, that's what we just
heard.
Like
hand-holding.
The hedge is not gold. The hedge is not treasuries. It's sit down.
I think
Let's talk
Kevin's
about
living
the facts.
that every single day. Kevin Gordon, Charles Schwab. Kevin, it's good to see you.
Good to see you.
Appreciate it. Thank you. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hakes. Hey, Yahara.
Hi, John. President Donald Trump wants something in return for helping Ukraine defend itself against Russia. He says his administration wants access to Ukraine's critical mineral resources like uranium, lithium, and graphite, which could be worth trillions of dollars. President Zelensky offered Western allies access to these resources as part of his victory plan last year. Meanwhile, Indian Prime Minister Narendra Modi has been invited to the White House. According to an official, Modi will meet with President Donald Trump next week. Modi seems to be on good terms with Trump. His government has made a series of concessions in recent weeks, including an overhaul of its tariff regime to try and avoid any clash over trade. And Pfizer shares are up 1.8% in the pre-market after beating expectations on strong sales of its COVID vaccine and pill. It's a welcome result for the pharmaceutical giant as it seeks to fend off criticism from an activist investor arguing the company squandered its pandemic gains and needs a new path forward. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara in 30 minutes. Up next on the program, the Morning Calls Plus, Angelo Zeno of CFRA previewing the latest earnings from Alphabet. That conversation just around the corner.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
The opening bell 1 hour and 11 minutes away. Equity futures on the S&P 500 just about positive by 0.1%. In the bond market, yields higher by a few basis points. We're up to 457.53. Let's get you some morning calls. First up, KeyBank reiterating its overweight on Spotify, highlighting premium subscriber momentum. That stock's flying. It's up by almost 9%, and Bramo promises
I will.
to get a premium subscription.
I'm going to. My workout's going to be amazing.
Your second call from Evercore, upgrading Marriott to outperform, citing a constructive view on travel demand. How do you work out in commercials anyway? That stock's higher by more than 1%. And finally, Morgan Stanley upgrading Palantir to equal weight, noting a lack of downside catalyst, that's for sure. That stock's flying. Untamed organic AI demand. What a headline coming out of that company. The stock is up 24%.
What can they do next quarter? Unruly, demand. I mean, how do you sort of make this even better? But they are the big beneficiary. And to me, your question to Dan Ives, how much of a shift are you seeing? The real winners become a very different cohort of stocks.
There's a new AI darling right now, and it's not NVIDIA, it's that one. And that stock performed, that's for sure, in 24, up by more than 340%. Let's stick with tech. China launching an antitrust probe into Alphabet, the US tech giant, reporting earnings after the closing bout today. Angelo Zeno of CFRA has a buy rating on the stock with a 220 price target. He joins us now for more. Angelo, can we just get something out of the way? How pointless is an antitrust investigation into Google in China?
It's very pointless. I mean, it was probably the first thing I thought of when I saw the news, right? I mean, I don't think investors are going to really think twice about this. I mean, the stock's not reacting to it at all. I think it was just kind of, China trying to add something else to kind of some of the tariff news that they threw out there, to be honest with you, kind of something on the headline side of things. And, something that you can say, hey, listen, we're attacking one of your kind of mega cap type names. But really, it's irrelevant, to be honest with you, for investors.
So let's focus on the relevant news, the news we get later, the earnings. What can we take from what we saw from Meta, from Microsoft, to gauge how we might see Alphabet perform a little bit later?
Yeah, so as far as Alphabet is concerned, I guess, you take away a little bit of from Microsoft and a little bit from Meta in some respect. On the Meta side of things, obviously it's all about kind of the digital ad side of things, and that looks pretty healthy as far as what you can extract for Alphabet. Clearly Alphabet is driven by search, whereas Meta is more on the social media side of things. But our view is, expect better than expected results as far as search is concerned, at least low double-digit growth. So for all intents and purposes, the run rate, it looks pretty healthy as far as search is concerned, not to mention the presidential election out there. It definitely helped Meta's numbers and should also help Alphabet's numbers. And as far as the cloud business is concerned, that's probably the most important thing we think from Alphabet here over the last couple of quarters. Is what's really allowed Alphabet, we think, to have some relative outperformance here over the last couple of months. I think there's definitely some fear out there, kind of the long-term trajectory of maybe Alphabet's core business. But as far as cloud is concerned, we've seen growth accelerate in each of the last 4 quarters. Last quarter, we saw a growth rate of about 35%. More importantly, the operating margins within cloud look extremely favorable. We're now looking at a run rate close to 17%, where a year ago it was closer to 3%. So they're executing kind of on all cylinders as far as cloud is concerned. Growth rates will probably decelerate this quarter, but based on what we've seen, from Microsoft and what have you, cloud growth looks pretty good still.
Just to follow on with that, Microsoft did say that they didn't have enough capacity to meet demand, and that was one of the reasons why people were a little tepid with their results. Do you expect a similar message out of Google?
Yeah, I mean, listen, as far as Alphabet is concerned here, I mean, on the cloud side of things, they're by far kind of the smaller of kind of the three big plays out there, right? I mean, Amazon and Microsoft continue to have the lion's share of things right now. So Alphabet essentially can take as much business as they can kind of essentially expand in terms of their capacity is concerned. So growth is not necessarily going to be an issue for them. It's going to continue to be, expanding that capacity and doing it in an efficient manner out there, which I think, the street is definitely keeping a close eye on. But when you kind of look at the last couple of quarters for Alphabet and you look at the CapEx levels, they've been able to kind of increase that capacity and look at growth rates at a much more kind of attractive pace relative to some of those other big mega cap type names. We'll see kind of what type of CapEx numbers they throw out there, but just given what we've seen here the last couple of quarters, expect them to kind of be fairly efficient in nature.
Angela, I do wonder what we're going to see in terms of efficiencies built in from the AI that's being deployed currently. We've seen a number of companies, tech companies in particular, lay off a number of their staff. Google or Alphabet might be a prime component of that, given that some of the machine learning programs could do some of the work that previous programmers and others could do. How much are you looking at efficiencies in some of these earnings reports?
I think efficiency is extremely important here. I mean, you kind of look, the last 2 years, we didn't necessarily see the efficiencies on kind of some of the AI adoption side of things. I think as you kind of go into 2025, into 2026, you're going to see a lot more efficiencies. Alphabet just kind of launched Gemini 2.0 back in December. That's going to, we think, lead to a lot more kind of, significant improvements in terms of reasoning capabilities, and what you can kind of deploy in terms of AI agents out there. We just kind of heard Meta last week kind of talking about an AI engineer that essentially you can kind of deploy a mid-level engineer out there at some point later this year. So you're going to see a lot more of that stuff, I think, as you progress through 2025 and into 2026. And I think that's why what we've told investors is to shift more onto the software side of things, because you are going to start seeing that AI monetization and those use cases really start to pick up as we go through 2025 and into 2026. I think Salesforce is another great example of that as well.
Angelo, in 10 seconds, what's their Waymo stake worth now?
Oh, that's a great question. I mean, I think the valuation of it right now is way less than what's being priced out there for Tesla. I don't want to necessarily throw a valuation out there, but they are accelerating the investments on that side of things. So we do think that there's a lot of upside potential on the Waymo side of things.
Think of all these powerful stories you're told about Tesla and full self-driving, and you've got Waymo over there getting it done, and Alphabet earns a big stake of that, Bramo.
Yeah, although hard to know how they're going to value that.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
New reporting out of the Financial Times just moments ago. I'll share the lead paragraph with you. Beijing has reviewed antitrust, or rather revived antitrust investigations into Google and Nvidia while considering a new probe against Intel. They go on to say as China looks for new leverage against US President Donald Trump. So reviving antitrust investigations into Google and Nvidia while considering a new probe against Intel.
The nature of the probe into NVIDIA in particular hasn't really been specified. If you take a look at pre-market moves in NVIDIA, this spike of volatility, and then it went right back to where it was because people don't know how much. This is just trying to seem like maybe there's a little more muscle behind this than we're investigating a company that hasn't done business here since 2010.
If you asked a lot of these companies their one wish under the Trump administration, just to stay out of the headlines. They don't want to be in the headlines. Well, those companies are in the headlines right now, and not for good reason. Equity futures elsewhere doing okay, just about positive by 0.1% on the S&P. Speaking of the big tech players on the NASDAQ 100 higher by 0.25%. With 60 minutes until the cash open, the opening bell just around the corner. Here's Manus Cranny with your morning movers. Hey, Manus.
Jonathan, just on the back of those FT headlines, that's what Adam Posen talked about this morning. The kicker. This is the step up from the normal tit-for-tat between China and the US. And that is the much bigger risk. Palantir, what a press release. Dan Ives framed it beautifully, printed off, stick it up in the Louvre. That's how good it was. This company is promising untamed organic growth demand in AI software. This is where the rubber meets the road in terms of efficiency. And as for Doge, it's going to be like manna from heaven for this company. Their guidance, 2/3 of their revenue comes from the US government. US commercial sales this year will rise by 54% to just over $1 billion. We're in a new phase, says the CEO, Alex Karp, and warned against technical complacency. So much so that Bank of America have upped their price target on this to $125. I mean, we've already managed to do 50% of the uplift in price. Roll it forward and have a look at Spotify. Again, it's about whether you sign up for the premium product, and 265 million people have, and that's way ahead of the estimates. It's the first ever full year of profitability, and this company was lambasted really for spending. This time last year, they re-signed Joe Rogan, remember that, $250 million, and the hubris was, you're spending $1 billion on podcasts? Now it's about the monetization of those. They've raised the subscription prices as well. I'm still on the free one. I've got plenty of other subscriptions. I have too many subscriptions. Estee Lauder, change costs, about $1.2 billion to $1.6 billion in restructuring charges. Nearly 7,000 to up to 7,000 jobs can go. Somewhere between 5,800 and 7,000 jobs will go. Net sales for this quarter will drop by double digit, by 10%. They've got problems at duty free. They've got problems with Asia, sort of travel market as well. These pressures will endure. Soft retail trends persist in the Asia retail market. Stock down 7.4%. Maybe I should upgrade myself on Spotify. Another app.
I was saying to Lisa, like, let's get real. You're in the gym and you work out with Spotify on, and you're telling me you listen to the commercial breaks as that's happening?
No, definitely not. I'm with you on that last big push, and you just want to be solely focused. You don't want any interruption of anything like news from you or me.
What's that Rocky song?
I don't know.
What's that Rocky song?
I don't listen to it.
I'm a tiger. Isn't that your gym song, Bramo?
And then Pampers.
Pampers?
The ad in between.
Oh, okay. Forgive me. All right, your workouts are different to mine. Okay, let's turn back to trade. Okay, economists passing through the potential impacts of President Trump's tariffs. Greg Dacker of EY writing, tariffs should create, keep it together, a stagflationary shock while also triggering financial market volatility. We expect US GDP would contract by 1.5% in 25 and 2.1% in 26 relative to our baseline. Greg joins us now for more to talk about trade. Greg, good to see you.
Good to see you guys.
Thanks for dropping by. Big changes from this administration for about 5 minutes and then they don't go on. As an economist, what do you do with the uncertainty in between? How does that change your outlook, if at all?
I think it's very important to factor the uncertainty because what we've seen is essentially a desire to work on four policy front: trade policy, tax policy, immigration, and regulation. But at the same time, there was this pro-business sentiment right after the election that essentially businesses would be supported in this environment and would drive stronger business investment, which was really the hope. What we're seeing and what we've seen over the last 48 to 72 hours is that there's also going to be this layer of uncertainty. And if we recall 2018, 2019, we had a similar mix of policy uncertainty that actually deterred business investment and hiring at a time where we were passing the Tax Cuts and Jobs Act. So you had trade policy uncertainty that was constraining to some effect the potential boost from tax cuts at the time.
Just to think about this logically, I can't think of a good reason of why it would hold back domestic capex. I can think of a good reason as to why it would hold back decisions about investing in places like Mexico or Canada. But for a US-based company, did we actually see them hold back on domestic capex decisions as well?
I think it's not about the last 48 hours. I think it's about the last few months, where pre-election there was a lot of uncertainty as to who would win the election. After the election, there was a lot of uncertainty as to what policy would be prioritized. And what we're hearing from clients across a multitude of sectors is that there's a little bit of that wait-and-see approach. It's not a retrenchment approach. We're still seeing strong trends when it comes to economic activity. The economy in the fourth quarter is still growing around 2.5%. Final demand, very strong still. But we are seeing CapEx be a little hesitant. And my fear is that we start to see that replicate itself into the labor market. We have a robust labor market. That's a key fundamental pillar to the U.S. strength and the U.S. outperformance. If that starts to become weaker, that could be a catalyst for weaker income growth and more caution on the consumer end.
We do have some tariffs to talk about.
We do.
So not all of them were avoided. We've got 10% on China. Let's lean on the experience of 18, 19, and we can discuss the differences as well because there are many. I want to understand from your perspective on how you think these tariffs and the costs will be distributed. So I keep saying this up front just so we don't have to even deal with the debate. The tariff is, of course, paid by the importer. How the cost is distributed, though, is unclear. You can have the exporter drop prices. You could have the companies absorb it at the margin. Or, of course, this can get passed on to the end consumer. Given where we are in the economy at the moment, how do you think about how the cost gets distributed?
There are two factors that I think are really important to consider when it comes to the overall economy. One, we're coming out of an unusually high inflation environment. Over the past 2 years, we've seen inflation come down, but it reached levels that we had not seen in 4 decades. Very different than 2018, where we were coming out of 4 decades of low inflation. Number two, the economy is close to capacity. So that means that any potential supply pressures that comes at this time could be more inflationary than it usually has been. So you combine the fact that we have likely more pricing power or sentiment, a sentiment of stronger pricing power with the fact that the economy is evolving close to potential, and you have more inflationary risks on that front. Both of these, I think, are important to keep in mind when it comes to the overall inflationary dynamics, and I think that's why you're starting to hear a little bit more from the Fed leaning on the more hawkish side, that contrary to 2018, when it may have been optimal to look through these tariffs, there is a risk that inflation may become stickier.
Surely you would have to believe, though, that not only corporations will pass it through, that there is some price tolerance for the consumer at the other end, that they'll keep buying, that we won't just see demand fall off. Are we knocking on the door of the limits of consumer price tolerance in this economy?
I think we are. We're already seeing it in terms of lower to median income families. They're already being much more judicious with their spending outlays. And that's why you're starting to see consumer spending trends soften gradually. No major pullback, but you're starting to see the pace of growth of consumer spending gradually moderate. And that is a key risk. As we should not forget, the U.S. economy is in a sustainable state right now. The outperformer on the global scale, the exceptionalism is still firmly in place. But the fundamentals underpinning this exceptionalism are at risk. The labor market is at risk of a pullback if business sentiment starts to turn. Productivity growth is at risk if companies do not focus on driving stronger supply, but instead focus on managing these policy disruptions. And income trends are still solid, but they're cooling.
So final question on the bond market, and I'm not going to ask for a trade on fixed income. Just to look at the signal from yesterday, yields dropped at the long end. There were some people, including BMO's Ian Lingen, that made the case that perhaps investors are starting to focus on the demand consequences, the growth consequences of tariffs, and maybe less so, relatively speaking, on the inflationary consequences. Based on the conversation we've just had, are you doing the same thing?
No, I think both elements are still very, very important. They're important because in an environment where you're focused on driving that sustainable growth environment, you have to be conscious that both elements are important. Having an environment where you're driving stronger productivity growth, you're driving stronger labor supply, those are conducive to sustainable growth at a higher level and essentially augment your potential to grow, which reduces inflationary pressures. That's really key. I'm going to be very much focused on the productivity data at the end of this week to see how strong productivity is, because a higher productivity level or higher pace of growth is a luxury that affords you higher inflation, higher wage growth, which feeds into income and allows consumers to spend more freely. Both elements, growth and inflation, are important. They're also very important for the Fed, because let's not forget, the Fed has two mandates, the employment mandate and the inflation mandate. They've put more emphasis recently on policy uncertainty and the risk to the upside for inflation, but they're extremely data dependent. So softness on the labor market front would likely lead them to turn more dovish again.
Greg, this was smart. The debate continues. It's good to see you. Thank you, sir.
Good to see you, as always.
Greg Dacko there of EY. For those of you just tuning in, the opening bell about 50 minutes away. Equity futures just about unchanged, slightly positive. Lots of data still to come this week. On Friday, had Greg mentioned the productivity data he was looking for. Payrolls is just around the corner. That's the big one. And then you've got job openings later on this morning, ahead of lots of Fed speak too. So let's bring in Michael McKee for a little bit more. Mike, what are you going to be focused on later on this morning and through today?
Well, we'll be focused on anybody making any kind of news. You know, when, John, when you and your lovely bride get invited to a party you don't want to go to and you just go kind of stand in the corner, that's about where the Fed is right now. We're going to hear from a lot of folks, but they're not going to have much to say. Yesterday, we already started off with 3 Fed officials saying, we probably need to be on hold because we don't know what's going to happen. Austin Goolsbee, the most important of those, because he had been the guy who was talking about, another 100 basis points of cuts in the coming year. He was ready to cut rates, and now he's on the sidelines because nobody knows what's coming out of the White House. We do have a lot more coming up this week. One of the most interesting ones is going to be Philip Jefferson. He's speaking twice. He's the vice chair, doesn't often speak. One of his speeches is on the economic outlook. So we'll get a sense of where the leadership is with him. And then tomorrow, Tom Barkin stops by to talk with the 3 of us. We're going to have a nice chat with him about what he sees, what people in his district see, and whether we can take literally the president's views, or whether the Fed does, at least.
It's going to be a timely conversation, Mike. Thanks for that. Looking forward to it. Mike will be leading that tomorrow, so look out for that on this program on Bloomberg Surveillance. Let's turn to fixed income. Tariff uncertainty pushing yields higher at the front end of the curve just yesterday, but a little bit lower at the long end of the curve. Tony Rodriguez of Nuveen writing, we expect tariffs to exert a flattening influence on the curve and to put upward pressure on spreads. Tony joins us now for more. Tony, good morning. Good to see you. Let's separate those stories then. We'll talk about corporate credit in just a moment. I want to focus on the Treasury curve. So yesterday was really interesting. Yields pushed higher at the front end, a Fed component there that we can discuss. At the longer end, yields dropped on 10s. Can we start with the longer end? What explained that move for you?
So from our perspective, I mean, we do think that ultimately the stronger influence from this whole tariff war and tariff situation is the drag on growth. So I think at the long end, you begin to see that put into place. If you think about what happened since, let's say, the fall of last year, almost 100 basis point rise in rates, a lot of that was on the pro-growth, positive growth side of the equation, whether it was deregulation, whether it was tax cuts, whether it was more fiscal. We saw the jump in yields because of the stronger growth picture. And we also saw Fed cuts being priced out. As we sit here today, the kind of drop in yields, I think, now begins to reflect that longer-term negative impact on growth from longer-term sustained tariff policy, not from these, 25, 50% that get reversed quickly, but more the sustained story in tariffs, which is what we're expecting, that we're going to see an increase, not from the levels that you see as kind of the, initial salvos, but there will be a rise that ultimately does drag on growth a bit in the U.S.
Is there a takeaway from that action that goes beyond just a couple of minutes or a couple of days? And it's not necessarily where the benchmark yield is, but it's the trend of yield curve flattening after an entire year of yield curve steepening. Can you bet on that flattening to continue?
Well, we don't think it'll be a strong influence. We think fair value is kind of around 25 basis points, 2's 10, so it's kind of where it's living. So at the margin, what we're seeing is just that Fed cuts get kind of pushed out when you see these tariff increases get implemented, right? So whether you think the first cut might be in May or June, it might actually get pushed out into 2026 if you see a much higher level of tariffs that are sustained for a longer period of time against more trading partners. So that's, I think, the story around the curve stays higher for longer at the front end. The back end will begin to price in that weaker growth story that comes into play in the medium term from those higher tariff levels.
Which goes to your other point about wider spreads. Can you talk us through what the logic is behind that at a time when a lot of people are waiting for those pro-growth policies to also come down the pike?
The story there is really that so much of the good news is priced in. So the pro-growth policies, if they do get implemented, if you see that from a regulatory standpoint or from taxes, et cetera, we've already got that in the price on credit spreads. So while we're not expecting any large rise in spreads, we do think you'll see a little bit of a recalibration wider. We think you'll see defaults increase a bit over the course of the year, stay probably below long-term averages, but not be at the, almost generational low levels that we've experienced over the last 1, 2, 3 years.
There's a US bias to this conversation. If we could just make it a little bit more international and talk about what happened in Europe yesterday, I thought the read on European sovereign debt was a lot more clear. This wasn't about some push and pull between the ECB going one way and growth going another. This was very much about the ECB is going to have to confront a disinflationary shock potentially, because if the wars go up in America, they're going to have to stomach a lot of cheap Chinese goods, and they don't get to distribute that around the world in quite the same way. How bullish are you on sovereign debt in certain parts of Europe with that in mind?
Yeah, we definitely think you're going to see more cuts from the ECB. They're going to continue kind of at a per meeting pace, we think, till they get down at least to 2%. Possibly have to go lower if, in fact, the growth impact is stronger. So we do think sovereign yields there are able to decline. It's interesting because when you think about the U.S. story, we talk about internal risks to the kind of growth story and external. External is really around global growth. And Europe is one of those stories where huge economies suffering some pretty strong headwinds in our mind. You think of China as the second largest economy, not really a growth engine right now. They're trying to implement some policies, but that's really just cutting off the tail risk of a really hard landing in China. So that external risk to the U.S. economy comes from weaker growth, and that is reflected in a more positive sovereign yield, outlook, and in Europe in particular.
There's a bit of a cliche on Wall Street that the dollar goes to where it's treated best. And when we've had a conversation on this program through this morning about whether U.S. policies and this policy platform would attract capital or push it away, overwhelmingly the response is still that it will attract capital. What are the odds that it will push it away? We had a guest sit in your seat yesterday who was trying to make a very strong case that he thinks because of the policy chaos, it pushes away capital, that it will go elsewhere. But when I have conversations about Europe and China, I struggle to see how that's going to attract capital anytime soon unless we see big changes in those economies. Where do you stand on that debate?
Well, I think it goes back to that old saying about cleanest dirty shirt. Right there, the policies themselves are ones that will, I think, dampen capital investment desires by U.S. companies, by foreign companies coming into the U.S. But at the same time, again, looking at that global picture, there aren't really very attractive secondary locations for that capital to go to. So at the end of the day, when you work through all of the math, the U.S. is still probably the most attractive destination for capital. It's just maybe going to be at a little bit lower level than it would be if you didn't have this policy uncertainty, policy chaos.
When we were in Europe a couple weeks ago, and we were listening to some of the messages coming out of the White House, the feeling around the table was maybe this will actually help Europe get its stuff together. And that essentially you could end up having deregulation there. Ursula von der Leyen just came out and said maybe we should loosen the purse strings a little bit to maybe invest in some defense. Maybe it would make that region better. And there are all these people talking about how they were getting optimistic on the region. Are you saying that's bogus?
Well, Mario Draghi, right, laid out the plan and was pretty clear. And that plan wasn't all that surprising, right? Those have been challenges that Europe has faced for now decades, really. So I wouldn't say that we're pessimistic on Europe, but we are, I think, realistic about Europe, that they're not going to implement competitive policy very quickly. It's going to take a long time. They're going to have to face some more stress and pressure. We do think they'll see that pressure over the balance of the year in terms of the economy. And then in reaction to that, you'll see incremental steps, I think, that move them in the right direction, but we're not expecting some big policy bang that, moves them suddenly to be a competitive, as they should be.
You know, the great irony for me with European leaders, I think if you ask European officials honestly, with the exception of Meloni and maybe a couple of others, about who they'd want to have in the White House, I think they'd tell you that it probably isn't Donald Trump right now. And the greatest irony of that is that actually this president will push them, and you've indicated this, to do the right thing, to do the thing to help themselves. And everything he said about Europe has turned out to be correct. Everything he said about Germany has turned out to be correct. Everything he said about NATO spending has turned out to be correct. And they've slowly come around to this idea that maybe this president was right. Mark Rutte, who was the Dutch Prime Minister, who we've interviewed several times, said that to us years ago. And now, as NATO Secretary General, is saying exactly the same thing. The president was right. And I think, Lisa, what you're getting to, and I've heard it from you several times through this morning, is whether this president will push them to do something that helps themselves. And I hope it does.
A lot of people do. And when we were in Davos, everyone was saying that it would, and that they were getting more optimistic on Europe. And yet here we are with a lot of that unwound, with the suggestion of tariffs. This, to me, is going to be one of the big sort of underplayed stories of 2025.
Tony, it's good to see you. Thank you, sir. Tony Rodriguez there of Nuveen with an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Heckes. Hey, Yahara.
Hi, John. President Trump plans to speak to Chinese President Xi Jinping about a potential reprieve on the 10% tariff. The White House press secretary told Fox News talks are expected to take place over the next 24 hours. The president also plans to speak to his Chinese counterpart about fentanyl. The U.S. Secretary of State Marco Rubio told Congress that the U.S. Agency for International Development may be abolished after a review. According to a letter seen by Bloomberg, Rubio wrote that the current foreign aid process does not benefit the American people. He says some U.S. aid operations may be integrated into the State Department, while others would be shut down. And PayPal shares are falling more than 8% in the pre-market, even after it reported fourth-quarter earnings that topped Wall Street estimates. But investors are focusing on a slowdown in growth of its card processing business. Growth in that area slipped to 2% in the fourth quarter from 29% a year earlier. That's Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the program, we'll go through the trading diary, bring you the calendar for the day ahead. From New York, you're watching Bloomberg TV.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The opening about 36 minutes away. Equities just about unchanged on the S&P 500. Your trading diary, your calendar for the day ahead looks like this at 10 a.m. Eastern Time. Jolts and durable goods data, plus Alphabet earnings after the closing bell. Look out for that this afternoon. Wednesday, ADP, trade balance, and Disney earnings. Thursday, another round of jobless claims and a Bank of England rate decision, plus Amazon results after the close. And on Friday, the payrolls report just around the corner. Before we leave here, let's head down to Washington, D.C. and get a final word from Anne-Marie. MH, what's on the agenda for you and the team?
Well, officially on the agenda, President Trump will be sitting down with Prime Minister Benjamin Netanyahu of Israel today. This is the first foreign official to come to the White House to have this meeting. Of course, this happens as the second phase of the Gaza ceasefire. Those talks are beginning to take shape. His Middle East envoy, Steve Witkoff, has really indicated he wants to see that truce because, of course, then that means for President Trump, he can embark on potentially more regional peace deals when it comes to normalization, say, of Saudi Arabia and Israel. What's not on the agenda, but I'm sure market participants are looking forward to, is this potential phone call that Trump says he's going to have with China. He teased it out yesterday. He said potentially me and China will get on the call, Xi Jinping, and then Caroline Leavitt, his press secretary, reiterated that to Fox News. No time, no scope of what potentially they might talk about. Obviously, tariffs will be one of them, maybe TikTok, but that's something to watch out of Washington today.
These calls are becoming market moving. We said that at the end of the program yesterday, and it turned out to be right. Those calls between the Mexican and Canadian leaders, that's one to watch potentially a little bit later on today. Tomorrow, this is one to watch. Lindsay Rosner of Goldman Sachs, the Disney CFO, Hugh Johnston, the Richmond Fed President, Tom Barkin, and the Chevron CEO, Mike Wirth. Bramo, what a lineup for Wednesday.
Especially at a time where each of these industries is being challenged in real time by a host of policies that may or may not go into effect.
From New York City this morning, good morning. Thank you to you all for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit. Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
All right, no relief rally just yet, but we still have 30 minutes until the start of trading. I'm Katie Greifeld.
And I'm Romaine Bostic. Matt Miller, Shanali Bassick are off. Bloomberg open interest. It starts right now.
All right, coming up, China hits back, but in a measured way. Beijing slaps tariffs on $14 billion worth of U.S. products. For context, the U.S. put tariffs on $525 billion of Chinese goods. Meanwhile, out on that earnings front, untamed AI demand, Palantir, just surging right now on that bullish outlook. And next up, Alphabet reports today after the close. We'll navigate it all with Morgan Stanley top stock strategist Mike Wilson. He says that the recent developments in the market favor services industries. All that and more, but let's take a check on these markets right now. Like I said, not exactly a relief rally. We did manage to pare some of our losses by the close yesterday, and right now you can see the S&P 500 just about unchanged. Of course, the back and forth, the will he, won't he, when it comes to tariffs, really whipsawing this market. But you do see a little bit of green when it comes to big tech. Of course, Palantir helping out there. The NASDAQ 100 currently up by about 0.1%. A small gain. We'll see if we can find some momentum there. Finding some momentum in the bond market, at least when it comes to yields, moving to the upside. The 10-year Treasury yield currently higher by about 3 basis points right now, Romaine. We are just below 460 on that 10-year yield. We've been calling it the danger zone here on open interest. You're usually on the close.
I'm usually on the close, a different danger zone on the close. But we go back to equities and some of the big movers in the pre-market. You mentioned Palantir, 23% gain in the pre-market after its full-year revenue forecast. Blue Pass estimates driven by untamed organic growth. That's quote marks there. Demand for AI products here, setting up for what could be its best day in a year. Estee Lauder, though, going in the opposite direction. It's planning to cut as many as 7,000 jobs as part of a restructuring and says revenue this quarter could drop 10 to 12%. Analysts had only modeled for about a 7% decline, 5% lower on those shares in the pre-market. Spotify, though, getting a nice boost here after it reported its first ever annual profit and 675 million active users. Katie, I assume you're one of them.
Oh, big time. I cannot cancel my Spotify subscription, and I guess you can see that in the numbers. But we should probably talk about tariffs a little bit more. Of course, earnings a big theme today, but also, too, tariffs. Because, Romaine, it feels like most of the language about what we saw in retaliation from China has been measured, restrained, cautious. But then you take a look at PVH, you take a look at Illumina. These are single companies that have been added to the so-called Chinese blacklist. They're moving significantly lower pre-market. So maybe it's restrained overall, but at the single stock level, a little bit painful.
It may be restrained overall, but you kind of wonder if this is sort of a more of a strategic move by the Chinese, saying we're not going to do this blanket thing that Trump did, but we will go after very specific companies. You have to be worried if you're an investor, right? I mean, PVH, Calvin Klein, Tommy Hilfiger. I know you're a big Hilfiger fan there. But I mean, mean, they rely, I think I saw a statistic, it's something like 6% of their revenue comes directly from China, but also the sourcing is also a big issue there. And then with Illumina, I don't know if you're an Illumina customer, that's like gene testing.
Not quite.
But again, they get about 8.5% of their revenue from China.
Yeah, big time. And I think it's an important point that you think about just the unpredictability here. Of course, that's part of the negotiation, I suppose, but for an investor, a huge headache. Let's try to make sense of some of it with Anne-Marie Hordern. She is Bloomberg's chief political correspondent and the co-host of Surveillance, joining us from D.C. right now. So let's talk about China first. Of course, tariffs on $14 billion worth of American products. We've been calling this restrained, measured, cautious. Is that the terminology that you would use?
I think so. This is a gentle response from Xi Jinping when that 10% came into play just after midnight overnight. Also won't take effect until next week. So potentially offering an olive branch to get on the phone, which Donald Trump teased yesterday, and then his White House press secretary reiterated that to Fox News. Potentially there would be this phone call. But you are going to see 15% tariff on coal and LNG, but this is less than $5 billion of U.S. energy imports, and then a 10% levy on some other things like oil, agricultural equipment, and then you guys mentioned PVH and another company as well being added to China's unreliable entities list. So you are seeing China hit back, but it's calibrated, it's specific. We should also note adding an export controls on a number of critical minerals and metals like tungsten, which is used in the defense industrial complex. So you do see this calibrated. Jonathan earlier called it a pinch, not a punch, but potentially, as opposed to Canada and Mexico, when it comes to China, this is the opening salvo.
Yeah.
This story's not over.
Well, what I'm curious, Anne-Marie, is what could China do? I mean, they're not going to send 10,000 troops to their border because obviously that would make no sense here. So if Xi Jinping were to offer some concessions to try to placate Trump, what exactly do they have to offer?
Well, I think one big one would be TikTok, right? If they would allow ByteDance to divest TikTok and not really have this seal of approval from the CCP to actually let the market do that. I think for Donald Trump, that would be huge. He says he wants to keep TikTok around. Larry Ellison was actually in the Oval Office yesterday. We don't know why, but him and Rupert Murdoch were there when he was signing a number of measures yesterday, including the Sovereign Wealth Fund. He was talking about how TikTok maybe be bought with the use of this Sovereign Wealth Fund. We don't know a lot of details about this, but I think there are other levers to play here as opposed than when we saw Trump negotiating with China in his first administration.
All right, TikTok. Near and dear to my heart, to Romaine's heart
Could be one.
as well, I assume.
Anne-Marie. I'm big on TikTok.
Say that again?
I'm huge on TikTok.
Yeah, I know. I follow you. Anne-Marie, great to get great to get your reporting with the latest from D.C. That, of course, is Bloomberg's Anne-Marie Hordern. Let's keep this conversation going now because joining us at the desk, we have Morgan Stanley Chief U.S. Equity Strategist Mike Wilson. Great to see you on set with us.
Great to see you.
So, Mike Wilson, you have the threat of cheaper AI models from China. I'm talking about DeepSeek. You have the threat of a multi-front trade war. When you think about your 2025 base case, has it changed at all in the past week and a half?
Not really. I mean, we're learning more every day. I mean, what a start to this president in the administration. I mean, there's so many announcements, and that was really part of our view coming into 2025. While we viewed the election itself a positive result for stocks because it's more pro-growth and maybe not so great for bonds, by the way, we're now seeing what we figured in the first half is a lot of uncertainty, right? I mean, a lot of announcements, okay, this stuff is going to take time to play through. It creates volatility, and that's what we're seeing. So, you know, at the index level, we think we're sort of capped, 6,100. We've been talking about that for a while. And really the action, as usual, what we try to do is find things to do both long and short inside the market. And we think there's plenty of activity. And so the announcements more recently, I think, support a lot of our calls, which are services over goods, software over semiconductors as two good examples, maybe industrials over some of the consumer-oriented plays. And these are the things that I think we can do as investors until we know what the impact of these policy changes are.
As you try to assess that impact, though, everyone's already trying to put a number on sort of what the effect would be on GDP. Even if he doesn't go through with these tariffs in full, the 2025 and 10, is there a concern that the uncertainty itself could dampen economic activity?
Exactly, and really that's really important for earnings too, Romaine, because GDP isn't guided necessarily, right? But earnings estimates are a function of company guidance, and so companies probably are feeling a little apprehensive here. let's see what goes through, let's see what doesn't go through. I'll give you a good example. In December, we saw a big pull forward of goods volumes because, people are smart. They're like, let's get ahead of these tariffs. Then people forgot about the tariffs for some reason because nothing was announced on Inauguration Day. And then they come in like, oh, I guess this is real. So maybe that could, forestall some orders because people will say, well, we ordered a bunch of stuff extra. We don't know how long it's going to last. Let's just take a break on some of the orders and see how it goes. And I think that's the part that makes it difficult for investors to model earnings. It makes it hard for companies, quite frankly, to model that earnings, which is why we want to stay more domestically focused, things that aren't as geared to these types of shocks.
Well, to that point, Diageo this morning, it's a British maker of Johnny Walker, et cetera. Yeah. It removed its medium-term sales guidance basically for that reason. It's really hard to forecast the future when you don't know what's going to happen. But you mentioned that you're looking at both long and short things to do in this market right now. The long side is interesting, but the short side is really interesting. What are you thinking about there?
Well, things that have dollar international exposure, right? The dollar's very strong, and that is another reason for a headwind for potentially guiding, or even producing better sales growth. So staying away from some of the more multinationals that have currency exposure, translation risk, in addition to goods and export risk. Staying away from goods, goods that are affected by these tariffs, and it's just a straight hit to their bottom line. That's mostly in the consumer space where you don't have pricing power. We think in the industrial space, on the other hand, they could probably pass through some of that. That's what our analysts believe. So those are two good examples. And of course, the semiconductor area is one that's also being affected by this shift with DeepSeek, right? Where maybe the compute necessities are much lower now, and the real value is being driven at the application layer. That's been playing out, by the way, for 6 months. This is not new to them. The market's figured this out. And we've been on that one, and I think that just only continues.
I was going to say, it's been playing out for 8 days for a lot of us, and a lot of people did not know what DeepSeek was until last week, and I assume you were studied up, though.
No, I found out about DeepSeek, I think, what everyone else did. And it gets to this whole idea of sort of market surprises, and we kind of knew coming into this administration and all of the geopolitics around it, this market was going to be surprised. Is there a way, or do you think the market has the clout to push back at all? I mean, Trump has said, at least publicly, he doesn't care what the S&P 500 does. I don't know if I believe that, but that's what he says. And the bond market action, the bond vigilantes, at least for right now, seem relatively subdued.
Well, look, let's face it. President Trump is a populist president, okay? And most people in America don't have a big stock portfolio or a big asset portfolio. And so that's part of the reason why he got elected, was to come in and do things that maybe don't boost the S&P 500 so much, but maybe do things for the average person. And I think it seems to be pretty committed to that idea, whether it's enforcing the border, immigration, whether it's, dealing with China and some of the things that maybe are affecting consumer prices, trying to get inflation down, how we're going to fund the deficits, going forward, how we're going to cut back on government waste. I think that's what this administration seems to be focused on for now. Of course, he cares about the S&P 500 as a metric, like everybody does. I mean, it also has an impact on the economy. But we've made so much progress in stocks that I don't think a 10% correction is going to impact people's spending. Now, if you got a 20, 30% correction, of course, that would be something that would then affect the economic outcome. But we're talking about 3, 4, 5% so far. I mean, that's not going to affect people's spending habits.
Yeah, and we're about 2% from all-time highs really quickly, and you're coming back after the break. We're effectively talking about the Trump put here. Do you think that there's a Fed put that exists, or is Jerome Powell just looking through this?
Well, I mean, once again, I think the Fed also watches the S&P 500 only because it has a big economic impact. It's the most important asset in the world. Let's just be honest, right? I mean, more people around the world own that asset, so it does affect people's sentiment, affect company sentiment as well. Is there a hard put from the Fed? I doubt it. I mean, I think there's probably a point where it becomes there's a loop where it starts to affect their forecast, and that's where they care.
All right, in conversation right now with Mike Wilson over at Morgan Stanley. He's sticking with us here, a deeper dive up ahead into some of the earnings on the day, both before the market and after the market. In the pre-market, though, Katie, we focus in on some of those big movers, including PayPal, lifting its forecast as it aims for profitability, and investors, well, they're a little bit more focused here, I think, on some of the numbers that came in a little bit light in the past quarter.
Yeah, absolutely. Which is funny because usually it's all about guidance, but it just feels like everything is under a microscope right now. Let's talk about PepsiCo, because you can see that move developing here. Of course, sales missed in North America. It also sees slow growth for 2025. It just feels like some of these staples, you could say that, you know, buying a soda is discretionary. I know they do a lot more, but definitely under pressure right now.
And when you break down sort of each sort of unit in there, I mean, everything was pretty much down, had a negative sign in front of it in terms of growth. And how about Merck? This was kind of a curious story. The share is down 8.5% in the pre-market. This after it's halting sales of its HPV drug Gardasil into China.
Yeah.
And apparently, I couldn't figure out, some of this had to do with demand, but some of this had to do with some other issues as well. It looks like they're going to have to try to recalibrate how they want to approach.
Yeah, definitely. You can see the surprise in shares. I think a lot of investors and analysts looking for more color. Maybe we'll get that on the call. But stick with us. We have more with Mike Wilson coming up next. This is Bloomberg.
Bloomberg Invest is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of deregulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asia markets.
All right, now to high interest, a look at what's making headlines around the world. And we start off with President Trump holding talks later today with Israeli Prime Minister Benjamin Netanyahu. This will be the first visit by a foreign leader to Trump's White House. The talks are set to determine the next phase of Israel's war against Hamas, a joint press conference scheduled for around 5 p.m. Washington time. Meanwhile, fresh questions of conflict are being raised surrounding Kash Patel, that's President Trump's pick to lead the FBI. Patel received an $800,000 stock award last week from Trump Media and Technology Group. Disclosures around the new grant fall into a gray area due to its timing. If Patel were to hold on to the restricted stock as director, it could incentivize him to avoid undermining the value of Trump Media. And eggs, bird flu causing a national egg shortage in the U.S. Restaurants and grocery stores from New York to San Francisco getting hit by that surge. A carton of 1 dozen eggs now as much as $7 in some areas of the country. Since the outbreak of the disease 3 years ago, more than 100 million hens have had to be killed.
Yeah, watching that story very closely. I'm going to have to decide between Starbucks or eggs, which is a painful choice. But let's talk about these markets, because you do have a little bit of green on the screen, but really just in color alone, because the S&P 500, you can call that unchanged. NASDAQ 100, maybe a little bit of a lift in tech stocks right now. We know that Palantir had a big night yesterday. We'll see what Alphabet can deliver. And then you take a look at the small caps, also unchanged, but the color is red, Romaine.
Morgan Stanley Chief U.S. Equity Strategist Mike Wilson still with us here on Open Interest. And Mike, a big focus on earnings. We got a few this morning. We'll get a bunch coming later tonight that will certainly be impactful to this market. When you look at the companies that have reported so far, is it laying down sort of an encouraging sign about the health of corporate America right now?
Yeah, generally business is pretty good. I mean, the fourth quarter was our first double-digit growth quarter year over year in quite a while, and we saw a little bit better breadth. I mean, that's been the real missing piece, is that, you know, everybody complains about the Mag 7 or these 20 companies outperforming, but the reality is those are the companies that have delivered on earnings. Yeah. Some of that's cost cutting, but they've had some good top line too. And now our expectation is, assuming things kind of hold together, we will see more companies generate earnings growth in 2025. So we're seeing the beginnings of that, not fully yet. And so that's what we're really watching for. I think the risk this earnings season, as we predicted, would be, with all the uncertainty, would companies hold back a bit on 2025 guidance and also the dollar? And those two items, I think specifically, have held back some companies. That's why we're seeing some bad news and some good news. So it really is idiosyncratic. You hate to say, it's a stock picker's market, but it really is now. Last year, and even in 23 especially, it wasn't so much a stock picker market. It was just buy hard, large cap, quality growth. That was it. That's all you had to do. Now I think there's opportunity to do stuff more at the stock level.
It's funny, we keep hearing, like you referenced, that it's a stock picker's market, but it seems like you really mean it this time, so it'll be interesting to see how that shakes out. I want to talk a little bit more about big tech before we broaden out, because after we saw the DeepSeek headlines last Monday and people learned what DeepSeek was more broadly, one of the narratives that emerged was that CapEx spend by the big tech companies would be under a microscope as well. You think about Meta announcing that it was boosting its CapEx, Microsoft, of course, spending up to $80 billion. It seems like that hasn't necessarily played out. We haven't really seen a tempering when it comes to planned spend.
Well, what is happening is there's a big deceleration, okay, and that's in our numbers. So, the hyperscalers have been spending at an unsustainably high rate. So I think last year they grew spending about 50%, which is incredible given the size of those businesses. And I think this year we're looking for 20 to 25%, and then next year it could be as low as 10. So that deceleration, remember, stocks live at the margin, right? And at the margin, the second, the derivative, the second rate of change is decelerating. And that's why a lot of these semiconductor stocks have started to underperform, particularly memory and some of the secondary AI type plays. It's not that growth is going negative, but the deceleration has to get priced into the market. But that opens up CapEx for other areas. That's why we think the application layer is probably the next phase of development.
Well, it's going to be interesting. So later tonight after the bell, on the close, by the way, we're going to hear from Alphabet and we're going to hear from AMD. So two companies kind of at the center of what's been going on with AI, and more importantly, the AI spend. And I am curious if you are concerned at all about the lack of returns, at least the ones that would show up on the bottom line. Are you comfortable with the fact that we haven't seen that yet, even though these companies keep saying, look, we're going to have this run rate of, in some cases, over $10 billion, at least for some of the big hyperscalers?
Well, the market's concerned. I mean, that's why some of these stocks have underperformed since the summer. That's really when it triggered it in the June quarter of last summer. Some of the hyperscalers started to underperform. And that's the market's way of putting capital discipline around them. And so I think the company management teams will respond to that, which is another reason why we think, if you can't generate an ROI that, justifies the amount of money you're spending, companies will respond to that and they'll pivot. And we're seeing the beginnings of that. And I think the stock market, once again, has been figuring this out for the last 2, 3, 4 months. And that opens up opportunity for investment into other parts of the market.
Let's talk about some of the other parts of the market and how you're expecting them to fare on the earnings front, because you think about small caps and the small cap trade. It really hasn't worked. It's gone hot and cold, defying seasonality in a bad way. Do you think that earnings could breathe a little bit of life into that trade, or
not
TBD?
Yet. Not yet. We neutralized our underweight, our 3-year underweight last summer as just sort of like, okay, we've had so much underperformance, but the reality is that, and by the way, you have to be careful how you look at small caps. The Russell 2000 is one of the lowest quality indices in the world, okay? The S&P 600, on the other hand, is actually a much higher quality index. So that's one way to kind of look at the difference. We still think quality is going to be an important factor. So if you're going to go down into the small cap world, once again, you're going to have to be a little bit more company specific and say, I want to buy a company that have good balance sheets, generating free cash flow. It's not like I'm just making a big blanket bet on small caps. That's the wrong way to think about it. The only time small caps really outperform kind of en masse is coming out of a recession, because that's when expectations have been wiped out, earnings have been cut, rates have been cut significantly, and then you have operating leverage coming out of that. That's not the environment we're in. So there's opportunity in small caps, but once again, stock and sector level, not at the index level.
All right, you got to be selective in the small caps. Mike, it is always great to see you. Appreciate the time this morning. That is Morgan Stanley Chief U.S. Equity Strategist, Mike Wilson. Now, coming up next hour, how the U.S. consumer is feeling about travel plans this year. We'll speak with the CEO of Best Western Hotels. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
All right, welcome back to Open Interest. A quick check on futures right now. Now the color is red when you take a look at the S&P 500. The NASDAQ 100 trying to hold on to pre-market gains. The Russell 2000 also falling out of bed a little bit. It's interesting, Romaine. You still see this hint of caution in futures right now. Even if you look cross-asset, the dollar, oil has reversed the moves we saw yesterday, but it seems like stocks just can't really catch a bid.
Yeah, and you're really seeing the S&P pinned right around that 6,000 level, right on that 20 and 50-day moving average. The catalyst, I don't know where that's going to come from. Palantir is not enough to lift this market wholesale. Maybe Alphabet does that after the market.
We'll pose that question to Katrina Dudley. She joins us up next with less than 4 minutes to go until that opening bell. Stick with us. This is Bloomberg.
first time, or got to many times go visit with Steve Jobs to try to get an Apple box to be our box. And we were trying to merge boxes. And of course, they have Apple TV, we have our box. Never actually happened. And in one of the meetings, he said, well, you should give up because we're going to win that. But you should put Wi-Fi in all your boxes. And that's how you'll win. And you should be the best pipe. And he said the best dumb pipe. So I went home, went to our chief technology officer and said, what's Wi-Fi? And today we have the nation's biggest Wi-Fi network. And we have more customers. And 90% of your cell phone usage, 90% is Wi-Fi.
Right.
And that's because 70% of all the bits going over the internet right now are streaming. And streaming wasn't here 10 years ago. So I sit here and say the most exciting thing about our company is what's coming in the next 10 years that happens in innovation around the world, hopefully here in America, hopefully Silicon Valley, in LA and everywhere else, Philadelphia, and that we're going to continue to have bits per home go up.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
All right, we are moments away from the start of trading on this Tuesday. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld, and the pre-market picture, it's a prettier one than we were looking at yesterday. It took 3 phone calls, but we managed to get to a delay on tariffs when it comes to Canada, when it comes to Mexico. You can't say the same when it comes to China. Of course, we slapped those 10% tariffs on China. We saw the retaliation, and you can see the caution in the market right now. You think about where we closed yesterday, of course, down about 0.8% on the S&P 500. Not exactly shaking that today so far, but in any case, you can see that the bells are ringing and people are clapping. There's still things to celebrate, and maybe there will be more after the bell today when Alphabet steps up to the earnings front, because right now it's pretty quiet. You can see the S&P 500 pretty much unchanged, maybe a little bit of a lift, a little bit more of a lift when you take a look at big tech in the form of the NASDAQ 100. We know we got big numbers from Palantir, which we'll get to in just a couple minutes. That's giving a little bit of optimism to your big tech index, and I stress just a little bit. The small caps down a little bit right now. Of course, those smaller companies really buckling here under higher rates, even though, of course, they're more domestically focused, but there's a lot of cross currents right now. So let's look under the hood where things make a little bit more sense, because we're starting with the stocks that are heavily impacted by U.S. and China trade tensions. China added Calvin Klein owner PVH and U.S. gene sequencing company Illumina to that so-called blacklist, citing the impact on domestic firms in those sectors. The tariffs set to kick in on February 10th, and that leaves a little bit of room for negotiation, but even still, you can see people selling down these names a little bit when it comes to PVH, a little bit more when it comes to Illumina, down about 4.4%, Romain.
All right, well, that's the tariff story on the earnings front. Some big movers on the back of that, including Spotify reporting its first ever annual profit, 670 million monthly active users now on that platform. Estee Lauder, though, not doing well. A plan to cut as many as 7,000 jobs. Restructuring the company sees revenue falling 10 to 12% in the current quarter. Analysts had modeled for a drop of 7%. And PepsiCo, those sales missing estimates in the most recent quarter as North American consumers pull back just a bit on spending. It's forecasting the slow growth for the full year. Let's take a look, though, at the star of the show in the pre-market. It's got to be Palantir. The share soaring after its full-year revenue forecast blowing past estimates, driven by, quote, untamed organic growth and demand for AI products. AI going to be a big story today, not just from Palantir in the pre-market, but Alphabet post-market. Investors squarely focus on the cloud computing and search business for that company, which it faces intensifying competition. Let's get a closer look at what's going on in the tech space with whoever the co-host of Bloomberg Technology. Caroline Hyde joins us right now. Let's start with Palantir. 20+% gain here on the day. Alex Karp who I thought was kind of crazy, but maybe he's crazy like a fox. Yeah.
He's untamed. What he said, I mean, I love reading his letters. I love going to some of the webcasts. This is a guy that's talking about revolution, about people losing their heads, about organized violence, but ultimately he delivers, and he delivers well. We've got 36% growth. What's interesting is William Blair, as the analysts over there, are pointing out, look, compared to his 3-year forecast back in 2022, he's actually missing. He was going to say, look, I'm going to deliver you $4.5 billion in revenue. He's going to deliver $3.75 billion, but still the crowd goes wild. This is showing U.S. government growth, U.S. commercial growth. What it is, though, limited on is international growth. So that's an interesting hit back on what will be ultimately geopolitical tension that benefits them at home, but not abroad.
Pop quiz.
Uh-oh.
Where did Alex Karp go for undergrad?
Oh, I know the answer to this.
You read the
chat. It was a
chat.
tiny little college called Haverford.
Yes.
Is there anyone else famous that went there?
Katie Greifeld, also Howard Lutnick.
Okay.
Yeah, quite a...
Where is your talk of revolution? Why are you not talking of political scientists every time?
That's true, but...
your hair needs to go up more.
Yeah, you know, I'm working on it, teasing it up. We should probably talk about Alphabet, though, because Romaine threw it up on the board as well. Up about 1% right now, not quite 22%, but still nothing ahead of a really interesting earnings report this afternoon. What are we expecting?
Well, we're looking for solid revenue growth of 13%. You're going to get some decent earnings per share growth in excess of double-digit as well. But this is a company you want to hear about AI spend. This is a company you want to understand about whether the China investigation, whether or not suddenly this tension brewing between US and China and Xi Jinping trying to tentatively fire back by saying we're going to analyze from an antitrust perspective Alphabet, whether that's going to impact their Android business. Like, this is about phones, this is about operating systems, this is about anything but Apple over in China, and they are dominant there. So that'll be a key focus. But look, this is a company that we're going to try and understand whether their competition from DeepSeek is going to affect them in any way from an open source perspective. But ultimately, the search competition, lackluster. They have not given way in terms of market share, it would seem, thus far. And so they've continued to outperform. Search is going to be strong for them, and indeed advertising, of course.
Still waiting for that big embrace of Bing. Not exactly happening yet. Caroline Hyde, it's great to see you. Big show coming up.
Did she go to Haverford, too? Or?
I don't think so.
Okay.
I feel like she went to
With this
fancy.
voice, I think, unfortunately, I hadn't got into America by that point.
All right, Caroline, of course, the co-host of Bloomberg Technology, coming up at 11 a.m. But stick with us now. We have a great conversation with Franklin Templeton, Senior Investment Strategist Katrina Dudley, joining us at the desk. Great to see you, Katrina.
Thanks for having me.
So let's talk about tariffs. We had a blistering column out on the terminal from Bill Dudley this morning, and his read is that the stock market's reaction so far suggests that there's some hope that Trump is just bluffing. I think that's wrong. His words, not mine. The president genuinely believes tariffs will strengthen U.S. competitiveness and generate significant revenue. What's your reaction? What do you make so far of what we've seen in the market?
I think, first of all, he is not bluffing. This is an extension of tariffs that he's already put in place. But I think what's more important is the Chinese reaction here. Obviously, with Canada and Mexico, we've had those phone calls and we had that pause. But in terms of China, the amount of goods that they're actually putting tariffs on is very small relative to the basket, the 525 that we're looking to put tariffs on versus their 14. The second part of this is that if you look at how much of China, that they have like 3 times the exposure to America in terms of what we import versus what they import of our goods. So China is really on the hook here. And then finally, we've seen the data coming out of China. We know that the economy isn't strong. We know that the property sector has been kind of teetering there. So from that perspective, they need to tread very carefully. And that's a very different position than when we had the first round of tariffs.
Do you worry at all about the uncertainty around this, even if China remains restrained, even if Trudeau or whoever his successor is able to get Trump on the phone and placate him, as Scheinbaum did as well? The uncertainty and the volatility in between all of that, does that worry you as an investor?
I think that the U.S. as a market has just got so many good growth drivers and such support for economic growth, and economic growth is the driver of earnings. Earnings are the drivers of stock markets. So I don't think from a U.S. perspective we are particularly worried about it.
So no disruption in earnings?
I don't think you're going to see a disruption in earnings. I think that there's been enough telegraphing of this, number one. Number two, companies, the big risk is whether or not they can pass along these price increases, because obviously most of the goods that are imported from China are often actually incorporated into something else that's sold by
Katrina,
US
I can't take any more pass-alongs. I'm paying $7 an hour for eggs.
I understand that you're paying that, but you've also got a market where wages have been going up. So you've seen wage growth across the board. You've got a very strong employment market. So most of the people who are looking for jobs have the jobs. So even though, yes, it's not great, you're only feeling uncomfortable about inflation because you're coming from a period where you hadn't seen it. And so it's different from that perspective. But I grew up in an environment where you had inflation. And so for this regular increase in prices, we're just going to need to expect it, and it's a sign of actually a healthy economy, not an unhealthy one.
I hear what you're saying, but you think about just human psychology and the psychology of the consumer. Okay, maybe we feel uncomfortable because we're not used to inflation, but that's still our lived experience. So do you worry about the state of the U.S. consumer feeling uncomfortable and pulling back maybe on some big purchases, maybe on some of those experiences that have been supporting the economy?
Look, you're right. Experiences, services are the driver of the U.S. economy, which is why the tariff piece is such a much smaller part. But we're starting to see some signs of weakness. You saw some of the earnings in consumer products, which is a little bit worrying in terms of people just taking a pause. But a pause is not necessarily a stop. And I think that that's what we've got to be cautious about. But we're seeing it. You're hearing signs of people not going to dine out and eating in more, kind of just tightening that belt. That's the response to the $7 in eggs or the higher inflation that's showing through in your diner bill.
I do have to ask you about what's going on the technology side. Obviously, AI was a big driver of the market gains we saw last year. There is some concern about CapEx spending this year and whether we start to see more of a return for some of those companies and ultimately for investors.
Look, I think what we've had with DeepSeek is something that we've seen time and time again. History, it doesn't rhyme, but it definitely is very, very close. We've seen it in the fiber optic market where you had new technologies that make the existing technology more efficient. And what does that do? It basically makes it available to a broader swath of companies. And that is what the driver is. And that's why we think that the average stock is going to work this year, because we've talked about AI, but you've talked about the impact in a very, very narrow part of the market, and we're now seeing the use of AI broaden and the earnings growth outlook broaden across the market, and I think that that's positive.
All right, Katrina Dudley over at Franklin Templeton here on open interest this Tuesday morning. Stocks now open in the cash session. Major indices, the S&P, NASDAQ, and the Russell all in the green. Some of the individual movers that are helping to move this market here on this day. Well, Super Micro, remember them, Katie Greifeld?
Barely, Romaine. Tell me about it.
Up about 5%. I mean, they're at 28 bucks a share, a far cry from where they were during the heyday here, but maybe a little bit of dip buying here as people look for some bargains.
They figured out their accounting. We're all good there.
I don't know the answer to that, Katie Greifeld, and I don't want to get myself in trouble, so let's move on to the next one there.
There we go.
Some drags on the market. PayPal, down 10% here on the day. A little bit of concern here about what we learned out of their earnings report.
Yeah, which is interesting because they lifted their forecast. They're aiming for profitability, but can't overcome that when it comes to the past. And then you take a look at Merck, and this is what we were talking about earlier. This is a really interesting one, that profit outlook miss, but a lot of question marks about them choosing to halt Gardasil sales in China. That, of course, is an HPV drug, and you can see that weighing on the stock right now, down about 11%.
Don't forget Palantir. Palantir up 25% right now. Spotify up 11. Here's one from Matt Miller. Ferrari race up 8% here.
There you go. I have to say the Palantir.
There's a lot less talk about cars without Matt here.
Yeah, we're going to talk about Ford a little bit later.
Is he on assignment? Because he's been gone for like 4.5 weeks.
I thought he was diving. Okay. Indonesia, I had that on my mind for some reason.
Indonesia?
He'll be back eventually.
Wow.
At least that's
how did he get that assignment?
Sources tell me he'll be back, so we'll ask him then. But coming up, pull back. PepsiCo reports a miss and warns of a slowdown this year. More next. This is Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making. That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones. Can I say that in Bloomberg?
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I didn't really. Go.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, AMC getting upgraded to neutral over at Roth MKM. The firm says that the box office is entering a positive 2-year cycle and that AMC's risk reward feels more balanced. Next up, Tyson getting raised to neutral over at Piper Sandler. Strong chicken demand helped the food giant raise its profit outlook and beat earnings estimates. And finally, Juniper Networks getting upgraded to a buy over at Evercore ISI. The analyst says that the stock will move higher whether or not Hewlett-Packard buys it. And remember, Juniper reports after the bell today. Romain, I know you'll be all over that.
Absolutely. Here, we're also going to be all over Mondelez, which reports after the bell. We got a preview maybe of what we're going to learn out of PepsiCo this morning, posting a miss in its fourth quarter results. The maker of Cheetos, Pepsi, all your fan favorites, forecasting sluggish growth for the year ahead, citing a pullback from North American consumers. Those shares open lower by about 2.8%, now down about 2.2%. Dina Shanker, who covers food for Bloomberg News, joins us right now. That's a pretty big beat, Dina, but talk about Pepsi specifically here. I was taking a look at some of those growth numbers going forward here. I mean, this is a company that's been dealing with single-digit growth, in some cases negative growth. What's happening?
Well, what we're seeing is that consumers are pulling back across the supermarket. We're seeing that from a lot of different food companies. And PepsiCo says they are going to focus on value. That does not mean that they're cutting all their prices. Instead, what it largely is going to mean is offering new varieties of packaging so you can buy at a lower price point. They said they're going to emphasize some of their more value-focused brands. And they also mentioned that they are going to be leaning in on their, what they call their permissible, but what we would call healthier types of snacks, better for you options, mini meals. So that might mean their Sabra hummus, or they recently acquired Siete Foods, a healthier snack brand. So, and of course, they're also talking about efficiencies and productivity gains to help with their margins. So they've got a lot on their to-do list, I would say.
Yeah, they're like corn chips or something. I don't know if they're made out of corn, but it's like corn chips, but they're healthy.
Interesting. I saw Smart Food popcorn in the B-roll there. That looked pretty good. I'm a fan of that. But Dina, let's talk a little bit more about volume and pretty much the price to volume levers that they have to pull there. You said that they're not going to be cutting prices necessarily. Do they have any room to raise prices here?
You know, most of the food companies are cutting prices at this point, offering promotions. I think that raising prices is a really risky move at this point for any food company.
All right, so let's push ahead to Mondelez reports after the bell tonight, of course, Oreos. I mean, everyone loves Oreos. I am curious, though, Dina, kind of looking at Pepsi's earnings, and more importantly, what they said in there. Is it that people are eating less of some of those types of products, or are they just trading down, I guess, to either store brand type of knockoffs, if you will, and other sort of types of products that are just simply cheaper?
You know, it seems to be a mix. One thing that we've reported on at Bloomberg, and that was mentioned in the call today with the CEO of PepsiCo, is that there's growth in value, so that could be the store label, and in premium, so that would be more expensive options. So these companies have both directions that they can go in and try to leverage for themselves, but consumers are just getting pickier about what they buy at the supermarket.
And Dina, really quickly here, I mean, we've been talking a lot about tariffs that's weighing on the stock market, but you think about this big rally that we saw across the board, because there was a lot of hope that maybe we could see more M&A, we'd see more deals. When it comes to the food and beverage industry, what's the outlook when it comes to potential consolidation?
You know, it seems like every year they're saying there's going to be lots of M&A, and we'll just have to wait and see. Last year, we saw the biggest food M&A deal that of ever with Kellanova and Mars. But this year, who knows? Maybe we'll see more. We know that Mondelez had wanted to acquire Hershey late last year. That would have been a massive deal, but Hershey's the Hershey Trust, which owns the majority of the voting stock at Hershey, rejected that bid as too low. So could it come back? I don't know. We'll just have to wait and see.
Watch this space, as we say in the business. Dina, great to get some time with you. That, of course, is Bloomberg's Dina Shanker.
Have you tried these Post Malone Oreos? Has a little swirl on them? I've been looking for them. They're hard to find.
You know, I'm not up to date on my Oreo flavors because they add new ones all the time.
Yeah, that keeps you on your toes.
Yeah, I gotta browse the bodega a little bit more, but coming up, we're going to switch gears dramatically and talk about Apollo's plan to tap wallets of rich clients, finally paying off. Details on the asset manager's record haul in our Wall Street beat. This is Bloomberg.
Your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
right, it's time now for the Wall Street Beat. And Apollo's wealth business raked in record capital last year. The asset manager raised about $12 billion. That boosted assets from the sector by 50%. But you can see the shares actually a bit lower right now. So let's unpack that now with Bloomberg's Sridhar Natarajan. He is Bloomberg's chief Wall Street correspondent. We'll congratulate you again on the promotion. I know you love that. So talk us through this reaction because, okay, a record amount when it comes to private wealth, but it seems like overall AUM maybe a little bit of disappointment.
And I think that could be the major factor why the shares are trading a little lower today. Both at Apollo and KKR, which also reported earnings today, you see in the market reaction, the shares are down a little bit. Both of them came in a little bit light on the asset under management figure, but the more important factor is look at what the stock has done over the last year. At Apollo, it's been up 60%. Over the last 5 years, it's quadrupled. At KKR, it's gone up 5 times. So giving up a little of those gains is completely fine. I think the more important trend that analysts and investors are looking at is how do they continue to make inroads with their push to draw in those ultra wealthy clients, draw in more of the insurance money, continue to expand in that front. And I think it's fair to say that they're both showing reasonable amount of progress because that is a big area of focus for the entire alternatives investment firm space.
I'm glad you brought up the stock price performance because it's always fun to compare the market caps of these different asset managers because Apollo ranks at 91 billion in market cap. You take a look at BlackRock, which controls what, 10, 11 trillion dollars at this point. They're at 156 million dollars, which isn't too big of a gap when you consider the gap in their AUM.
But you also have to look at the products that they're hawking out there.
Yeah.
BlackRock's products are low-fee products, index funds. Those are not products where you're going to make a lot of money.
You can say ETFs.
ETFs, fine, Katie. I'm sorry. I forgot I'm talking to you. So you have to think about the fact that it's a volume game there. Whereas when you look at players like Apollo and Blackstone and KKR and the Carlyles of the world, it is about finding products that pay a higher fee and drawing investors to that space, whether it used to be your traditional pension funds and sovereign wealth funds to now insurers and the ultra-wealthy.
One interesting thing, and we can talk about KKR. I mean, you are our chief Washington Wall Street correspondent, I'm told. But when we talk about KKR's expansion or expansion of products, and specifically this idea of holding on to some of these investments, basically creating this strategic fund here, what is that a signal of? Is that a signal of the health and growth of the business, or is that a signal that they can't get rid of some of this stuff?
It's a little bit of the Berkshire model, right, where you're holding on to some of these private equity bets for the longer term with the understanding that they will continue to throw off dividends. So as long as that is an investment that makes sense, I don't think you should really look at it as whether they are having the right exit opportunity or not. They made a strategic decision there that they will hang on to those investments. Yes, there is a broader issue in the private equity space, something that we have tackled and wrestled with over the last couple of years, where a lot of these funds have struggled to get out of some of their investments, but the environment seems to be changing even on that front, and a lot more of these private equity executives and a lot of the bankers who are having these conversations are at least coming out there and sounding way more confident about their ability to transact and strike more deals.
All right, Sridhar, got to leave it there. Great roundup of what we're seeing when it comes to Apollo, to KKR, both down today in the stock market. That is Bloomberg's Sridhar Natarajan. Meanwhile, a quick check of these markets. We're about 26 minutes into the session. We do have a little bit of lift to markets, a little bit more when you train your eyes on the NASDAQ 100. We'll discuss next, of course, another hour of markets conversation coming up. Stick with us.
Hour?
A whole hour.
Oh, wow.
Don't go anywhere. This is Bloomberg.
offers before to take over Greyhound, but then in the midst of the pandemic 2.5 years ago, we had this fantastic opportunity to buy the brand and the network. When we took on Greyhound onto the Flix tech platform for network management, revenue management, we saw the highest unit economics in more than 100 years of Greyhound history.
My vision is to transform long-distance bus travel in the United States and make it one of the top considerations for anyone planning a long-haul journey.
CEO Kai Boyson imagines even more potential if state and local governments recognize the need to support long-distance bus travel with integrated infrastructure.
We need to think about the infrastructure in the United States holistically and think about the transportation system as one integrated system. And intercity bus needs to be an integral part of that system. One should be able to connect from one mode of transport to another seamlessly, easily. We have great success models in the United States. For example, Los Angeles Union Station, Boston South Station, or New York Port Authority Bus Terminal, or Washington, D.C. Union Stations.
Kai and the team, they are doing a fantastic job. They have really improved the product, they have improved technology, they have really made the production more efficient, that at the moment it's also a profitably growing business.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. President Trump meets with Israeli Prime Minister Benjamin Netanyahu at the White House later today. Senior administration officials tell CBS News the two men will discuss maintaining a ceasefire deal with Hamas and how to free the remaining hostages. CBS's Chris Livesay is in Tel Aviv.
Netanyahu met yesterday with the president's Mideast envoy to discuss how this peace can hold and said he would send a delegation to Qatar to continue indirect negotiations with Hamas. Nonetheless, challenges loom with hard-right members of Netanyahu's coalition demanding a return to war.
Mexico and Canada negotiated pauses in President Trump's tariffs, but China is retaliating against 10% levies that kicked in today by announcing new taxes on U.S. products. China expert Gordon Chang.
China presents a very special case because Beijing is now extraordinarily reliant on the American market and therefore can't allow American consumers to turn away from Chinese goods.
China says it's imposing new tariffs on coal, liquefied gas, farm equipment, and other American products. The Senate Finance Committee set to vote this hour on whether to advance President Trump's controversial pick for Health Secretary, Robert F. Kennedy Jr. Crews are hoping to raise more pieces of the American Airlines jet that collided with an Army helicopter from the Potomac River today. Correspondent Chris Van Cleve says the quest continues to find out what caused the crash that killed 67 people.
Investigators say they're still poring over both aircraft's flight data and cockpit voice recorders and have obtained training and flight logs for both flight crews, maintenance logs for both aircraft, and are building the crew's daily histories.
Several victims are still unaccounted for. They're bracing for something they don't need in Northern California right now, heavy rain. KCBS's Matt Bigler reports from Oakland.
The soil is already saturated, increasing the chance of serious flooding and downed trees. John Picard picked up a load of sandbags to put around his business.
Home, I'm fine. I'm not a floodplain. Business is a little concerned, but now I have sandbags that is pretty much mitigated. The good part about it is I'm going to Tahoe next week and expecting about 4 feet of snow, so the skiing's going to be awesome.
Dallas Mavericks fans are smarting over one of the most stunning NBA trades of all time that sends superstar Luka Doncic to the Lakers. They've set up a memorial with a casket outside American Airlines Center.
That's the heart and the soul of Dallas. You know what I'm saying? Like, I just don't get it. Like, I thought it was a joke.
And I actually have no words. The Dow is down 85 points. This is CBS News.
USA.com.
The FDA has approved the first clinical trials using organs from genetically modified pigs for transplant in patients with kidney failure. Up until now, xenotransplants from one species to another have only been allowed under the agency's compassionate use program when people are critically ill and running out of options. Experts say it could be a groundbreaking innovation. Dozens of immigrants in the South are being remunerated for wrongdoings committed against them.
60 migrant workers at the logistics company E-Green Transport Corporation in Savannah, Georgia, will split $580,000, just under $10,000 each. The U.S. Labor Department found that the company exploited the workers since the beginning of last year. Federal investigators found the company committed minimum wage violations, overtime violations, and illegally retaliated against the workers. Jim Crisula, CBS News.
NASDAQ now up 173. I'm Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live as well, so head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. We had some economic data today coming out, the JOLTS and some factory orders. We'll get to that later on this morning. We're going to check in with Vince Signorella, Bloomberg News. He covers all the markets, gives us a sense of where the action is out there. And the current Bloomberg Global Economy Report. Going to talk to us about the tariffs, particularly as it relates to China trying to hit back here on those 10% tariffs that the U.S. has imposed on some of these Chinese goods. David Havens, Bloomberg Intelligence Senior Credit Analyst. Interesting research here. Apollo, the private equity firm, raises record from private wealth as credit lures clients. It's this private credit business. That market continues to grow dramatically. Michael McKee, he's our economist here at Bloomberg. He'll break down the economic data for us. So a lot coming up in this first hour. Let's kick it all off with John Tucker and Getty Bloomberg. This is Flash. John.
All right, guys. Good morning. This Bloomberg Business Flash being brought to you by IBKR. Will the percentage of the U.S. experiencing drought conditions exceed 18% on February 18th, 2025? At IBKR Forecast Trader, the yes was recently at 35%. What's your take? Trade your prediction at ibkr.com/forecast. We are data dependent, so let's get right to it. The job opening and labor turnover survey coming on, kind of calling into question the resilience of the labor market. The figure surprising again, showing a lower than expected level of job openings at 7.6 million in the economy. Bonds extending their gains in price after that data. Right now, the 2-year, which is more policy reactive, down 1 basis point. The yield 4.23 right now. As for the major averages, S&P 500 23 points higher. That's up 0.4%. The Nasdaq 100 202 points higher. That's up close to 1%. The Dow right now, little change, down about 7 points. Right at midnight, President Trump imposing a 10% tariff on all Chinese goods. This morning, China did hit back, retaliating with targeted action. Not too severe, though, so it leaves room for negotiation, which is why we're seeing kind of a muted reaction. Palantir Technologies, you got to start there. As far as the individual stocks, that is the best performing stock in the S&P 500 right now. Palantir shares up 26%. Meantime, with uncertainty surrounding trade, Joe Quinlan at Bank of America telling investors to stick to the basics.
In this environment that we're in, tit-for-tat trade wars with China, I think the European Union is going to be out there as well in the crosshairs. So just be diversified and don't try to time the market or sell in or out of it. Stay in the market, stay diversified, high quality.
And worst performing stock, this is all based on earnings. Shares of Merck right now, they are down 10%. We also heard disappointing results from PepsiCo. Those shares down 2.2%. And Estee Lauder, that is a 16% drop for that stock. Here's the real news. The Waffle House restaurant chain putting a 50-cent per egg surcharge in place because of the bird flu outbreak.
What?
So...
The Waffle House was the place, no fuss, no muss. You go there, you get the good waffles, you leave. It's cheap while you go.
It's a thing out there, the egg prices. We've been covering that all.
Excellent. All right. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex Paul.
I'm assuming the egg, if it goes into the waffle, you don't pay for it. It's like a straight up scrambled egg or like over easy.
I don't know.
These are the things we think
about. A good
about.
reporter would delve into that. I just didn't care that much.
I'll work on it. All right. This is Bloomberg Intelligence Radio. Alex Steele here alongside Paul Sweeney. Let's get more on this market here. Vincent Signorella, Bloomberg macro strategist. He's also a former FX trader. Vince, there's a lot for you to look at right now. What are you looking at most?
Mr. Trump's kept me busy the last 2 days on the squawk. A lot of things to look at, but I think this more your wheelhouse, Alex. Crude futures. Strong bid this morning. The Trump is set to expect to sign an executive order restoring maximum pressure on Iran with sanctions, and this is an attempt to curb their nuclear capabilities. And just a moment ago, BP announced that they plan to spend $25 billion to redevelop four. Let's see if I say this right. Kirkuk fields. That's a headline coming from Reuters. So we'll see if that causes crude futures to pare back a little bit. But they've been ripping on that Iran news this morning.
Yeah, I was just looking at WTI crude oil. We did get just about an hour ago a low of just under $71 per barrel. Now we're back up here pushing up against 73. So it's been a round tripper for oil trading today. Talk to us about the currencies here. Is it still just dollar long?
Not this morning. We're seeing some dollar selling this morning, but that's because we're seeing some equity buying. They generally trade on an inverse basis. Given that the tariffs look like they've been pushed back for at least a month, and obviously traders hoping for more than that, we don't see the flight to safety with the U.S. dollar at the moment, so things are trading a bit normally. But, I totally would not be surprised if we saw a tweet or some sort of comments from the White House today that Trump was expanding tariffs on China because of their retaliation in a bit of a tit-for-tat type of moment. So got to be fleet of foot and be careful out there and very nimble because the landscape changes very, very quickly around here.
That's right. It's like trading versus investing. It feels very, very different. I should point out the Kirkuk fields are in Iraq. But so then that makes a difference when it comes to BP being able to develop there. But to your point, they are developing more oil maybe in the Middle East. They're pausing some renewable fuels projects in Australia. So just, Just putting that out there for the universe.
Yeah,
All right, Vince.
I told you it was in your wheelhouse.
It is. I know. I'm sorry. I'll explain to you. My bad. Vince Signorella, Bloomberg macro strategist, joining us there. Let's get back to the tariff conversation. Enda Curran is Bloomberg global economy reporter. China hitting back against Trump's tariffs, but many are saying, Enda, that it's like measured, that they could have been a lot worse. It was still friendly the way they put it out. Having covered Asia and lived in Asia for so many years, what did you make of it?
I think it was immediate in its response. It was clearly thought out, and they were ready to go with this. Alex, I was just looking at the list. There's the antitrust probe of Google, which isn't especially effective given the controls, the limitations of Google there. There are tariffs on agricultural equipment like tractors and other vehicles. There's tariffs on energy imports, coal and LNG, for example. Export controls on tungsten and other critical minerals. And then some of those companies like Calvin Klein owner PVH Co. are put on that entity list. So, you know, it's a reasonable list in terms of just breadth of how they're responding to the US, but it's nowhere near the dollar for dollar kind of matching figure that you might have expected, given the US has put 10% on all goods coming out of China. It is somewhat restrained. It's being interpreted as a signal, which is that, hey, look, we can retaliate further, but in the meantime, we're probably here to talk. And of course, we do know that coal is expected at some point between both leaders, Xi and Trump, over coming days. We'll have to see if that changes the story or not.
Yeah, that's kind of where I wanted to go, Enda, because we saw yesterday with Mexico, the leaders of Mexico and Canada, looks like a phone call can fix a lot of things. And these Chinese tariffs don't kick into February 10th. Does that give some potential for, again, as you mentioned, a phone call between Trump and Xi, maybe an opportunity to kind of take some of the stuff off the front burner?
On paper, you would say absolutely. Maybe both leaders are looking for an off-ramp. Maybe there will be negotiations. You know, the new administration, in their executive orders that they put out, said one of the first things they want to do is sit down and have a look at what happened in the original trade deal between China, the so-called phase one trade deal between China and the US. That would all lend itself towards the new administration having an assessment to see where things are and then come back. But nonetheless, things have moved pretty fast. I mean, I'm not sure anyone expected an almost full-scale trade war against Mexico and Canada that we came close to yesterday. If anything, President Trump has been very consistent in terms of his hawkishness on China and on the trade deficit with China, and of course on fentanyl and all of the other issues as well. So there are plenty of analysts who are saying that of all of the news over the past week, the tariffs on China were probably not a surprise. Maybe the timing of them more, but not a surprise. They were to be expected, and it does signal intent on President Trump's side. Now, of course, as you say, early days, we'll have to see how those talks go. But right here, right now, the US has put new tariffs on all goods coming out of China, and that's something that they hadn't done before.
What's the ask here? So clearly, with President Trump and Mexico and Canada, the ask was clear and had to do with fentanyl. What's the ask for China?
I mean, it's a whole different order of spectrum when it comes to the conversation, right? You're covering national security, you're covering IP protection, you're covering the merchandise goods deficit, the idea that the US doesn't think China buys enough stuff off of it. You've got the fentanyl issue. I mean, it's covering a whole range of issues here, and China's role on the global stage too, perhaps, in terms of its support for Russia, for example. But nonetheless, at least one thread on that is the merchandise goods deficit part of it. President Trump has highlighted that consistently. China in the past have signaled that they are willing to buy more US produce. And of course, at Davos, they had an official who made the point without naming the US. He said, you know, they're also willing to step up in the global market and buy things. So there are ways where we'll say the merchandise goods deficit could be reached, could reach some kind of a midpoint on. But the national security, the technology, the export controls, the IP protection, fentanyl, the human rights issues, all of that's more complicated and probably maybe a different channel to the trade side of things.
And one could argue that the U.S. economy is in a stronger position than that of China. Therefore, the U.S. may have some leverage here. Is that a feeling that you're hearing, or is that a policy backdrop that you're seeing in Washington at all or hearing about?
I think it's certainly considered to be the backdrop. U.S. economy broadly doing okay. Obviously, there are areas of weakness, but the consumer is still spending. That means the US remains the engine of global growth. We know the China story is still hampered by the real estate slowdown, but they're still pushing hard on innovation, as we saw with DeepSeek last week. So yes, there is a view that the US has the upper hand, but also practically, because if you're talking about getting into an argument over merchandise goods, and I'll put tariffs on yours and you put tariffs on mine, well, China can't match that dollar for dollar because they don't buy the same amount of stuff off the US that that the US buys out of China. So they're already at an imbalance in terms of a starting point. But they can retaliate in kind, like those measures we just talked about there. They can make life awkward for US companies operating in China. It can make life awkward for US personnel operating in China in terms of visas and the like. And they can also diversify and punish the US in other ways, diversify and find new markets, which you have been doing when it comes to soybeans, for example, and other agricultural produce. But to be clear, the US economy is strong at the moment. Of course, have the upper hand if it comes to tariff tennis, but there are ways where China can respond and retaliate.
Yeah, I didn't think that like PVH was going to be on my bingo list for like companies that China was going to go after. All right, Enda, thanks a lot. Enda Curran, Bloomberg senior economy reporter, joining us from D.C. All right, coming up, David Havens, Bloomberg Intelligence senior credit analyst, will be joining us on that news that Apollo is raising a record from private wealth funds as credit keeps luring clients into the fold. And Michael McKee joining us. Take a look at the JOLTS data, what to make of it. Everyone says that jobs data is going to be very noisy on Friday. So what's the noise? What's the reality? This is Bloomberg Intelligence. Happy Tuesday.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. And we are being brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. The offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. Right now, we have 6 of the 11 major industry groups in the S&P 500 higher, being led by energy and information technology. I got some mansplaining there.
Boom, go.
You did
or
go.
Alex-splaining, I'm sorry.
Alex-splaining, right.
Alex-splaining.
It looks like Exxon's recouped some of its losses from earnings on Friday. I have to wonder if it's the tariffs coming off, so maybe those higher Canadian prices won't be bad for their refining margins, but I'm totally speculating.
Which is why energy's in the lead, we think. Traders also wading through a batch of corporate results, and again, on high alert for anything regarding the potential impacts of the trade war. We have tech, which bore the brunt of the recent selling. Google's parent, Alphabet, they're due to report results after the close of regular trading today. Ahead of that, those shares right now are up just about 2%. And Palantir Technologies, that's one of the big stock stories of the day. Best performing individual stock in the S&P 500. Right now, Palantir is up 25%. That bullish revenue forecast doing the heavy lifting. And then one of the worst performing stocks in the index, Merck, tumbling. The company halting shipments to China of its cancer-preventing Gardasil vaccine. And shares of New Jersey-based Merck right now 10% lower. Overall, the S&P 500 32 points higher. That's up 0.5%, 6,026 on the index. The Dow Jones Industrial Average 21 points higher. The Nasdaq 100 up 227 points, a rise of 1%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate it. Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube. So head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. We were just talking about the tariffs with China, Alex. Some red headlines crossing the Bloomberg terminal. White House spokeswoman Caroline Leavitt is speaking to reporters, and she says that Trump will have a call with President Xi. It's being scheduled to happen soon. So there you go, some follow-up.
This feels a little bit like yesterday.
It feels a little bit like yesterday. I think we know this game plan here. Also, Punchbowl is reporting that President Trump is expected to go to the Super Bowl this weekend. So good for him. So there's your Donald Trump news and all that kind of stuff.
That's some security stuff.
Yeah, security stuff. They'll take care of it down there. Let's talk about private equity, private credit. One of the big names out there is Apollo Global Management. The wealth business raised a record $12 billion in capital last year. Just doesn't stop. Boosting assets from the sector by 50%. David Havens joins us, Bloomberg Intelligence Senior Credit Analyst. Apollo is just crushing it. So talk to me about, like, I grew up with private equity. A lot of us grew up with private equity. We kind of understand that. Barbarians at the gate and all that kind of good stuff. Private credit's a new gig, and it is a really fast-growing business, particularly for these private funds.
Yeah, and they're not barbarians anymore. I think they've become pretty civilized.
Yep.
And I think that what you're seeing is a replacement or a transition from public markets to private markets. It's not just in credits, it's in equity as well. And I think that what you're seeing is the ability of Apollo and companies like it to go into markets to originate vast sums of money, place that money in funds that have vast sums and access to vast pools of private wealth and public wealth around the world. And on the credit side of things, a company like Apollo is able to generate yields 200 to 250 basis points above similarly rated public instruments.
Wow.
And so it's alluring.
In terms of getting all the money, there are a lot of players in this world now, and there is always a finite amount of money, right? So, like, how are they competing, or is the pie actually big enough for all of these guys to play?
Yeah, so the pie is growing, right?
Okay.
So you've got infrastructure investment, you've got data services investment, you've got a sort of a whole bunch of secular trends that are requiring investment, infrastructure, energy, things like that. You've got a world which has been dominated in the past by public funds that have daily liquidity. Some of those public funds invest on behalf of 401k participants that have a 50-year asset cycle. So, matching up daily liquidity with something that has a 50-year asset cycle doesn't necessarily make sense. And so you're seeing inroads from the private side of things where, that money can sort of, has less liquidity constraints than some other pools of assets may. And then you've had indexation of so many things. So everything is sort of correlated and looks the same. And if you're in an S&P 500 fund, I don't know what percent of that is NVIDIA, but you're heavily skewed towards NVIDIA.
A lot.
So this gives you an alternative away from that, and you become decorrelated with that.
I see these monster amounts of money being raised every single year by these big private alternative asset managers. Where are they getting the money?
The numbers are all over the place, but you can look at estimates, I think, of $80 trillion to $120 trillion of private wealth, which could be tagged, for some of these funds. And private wealth is sort of defined as investors around the world that have over $1 million of investable assets. So massive, massive buckets of money, it's underutilized and underinvested in private segments and alternative segments.
So who are the winners and the losers so far? Like, who is outperforming in the private credit space?
So the big guys are all doing super well. So Blue Owl, Apollo, Ares, Blackstone are all killing it in private equity. There's a whole, or private credit. There's a whole tier of other guys that may not be, public or as well known that are also killing it. And where you're seeing it not being killed is on the banking side, because regulations over the past 10 or 20 years have sort of dissuaded banks from doing the traditional business of lending to middle market companies. And then in the public credit markets, again, you've got this indexation issue, which is really pushing everyone into the same bucket. So people are looking for alternatives. So another loser, public.
See, funds. Early in my career, I was at the Chase Manhattan Bank and the media group, and we were doing leverage loans, leverage lending. Then we'd go 5 times net debt to EBITDA. We didn't care. We were ripping it. Nobody took business from us.
No, and
I can't imagine how the banks are giving up this business because we crushed it.
They're not. It was regulation, right?
Yeah, well, you had a little thing called the global financial crisis. Banks got over their skis. Heavy-handed regulation came in and dissuaded the banks from making those loans. So the banks, I think what you're seeing is many of them want to retain relationships with clients because there are all sorts of fees that they can generate from these clients. And where you get the alternative guys coming in is accepting the assets that are coming out of the banking sector. Now, under the new administration and what might be a new slate of regulations or loosened regulations, you may see the banks wanting to hold on to a few more assets.
All right, I don't know. It was a great business. We syndicate everything. We didn't hold anything on our books, and we turn on the next day and do it again. Yeah, it was a great business. David Haven, Senior Credit Analyst, Bloomberg Intelligence, joining us here in our studio. It's good to have another adult in the room here. This Bloomberg Intelligence credit team is just like the best on the street.
So good.
Which is really, really good.
And they explain it for real people.
They do. They explain it for real people. Yeah, Joel Levitt putting all that stuff together. We got some economic data today. We had, what do we have? We had the
JOLTS.
JOLTS came in at 7.6 million. The consensus was 8 million. So maybe a little bit tighter jobs market there. And we got some factory orders, durable goods orders, and then, of course, later in this week, we're going to have change in non-farm payrolls. Michael McKee joins us here. Michael, the EcoGo function, there's a ton of stuff this week. What are you focusing on?
It's the first week of the month, and usually first week of the month is when we get most of the big numbers for the month. And it's been kind of interesting this week because nobody's paid attention to the numbers.
That's right.
Something else going on out there.
Experts.
We had, the first ISM manufacturing numbers to cross 50, the expansion level in more than 2 years, and we didn't even register, given what was going on.
We talked about it.
Well,
there we go. We did something.
You get props.
Yeah, thank you.
Today we have JOLTS. JOLTS used to matter. JOLTS doesn't matter anymore. It does show, as you mentioned, Paul, that 7,600,000 down from 8,156,000, which was an upward revision for November. The labor market is actually getting looser. It's it's the way you put which ones you put in the denominator and numerator. In this case, what people look at is how many jobs there are versus how many people are unemployed, and there are more people unemployed. When there's a lot of jobs, the labor market is pretty tight because you can't find people. So right now, it doesn't seem to be an issue. Quits stayed at about 2%, so no real change in the quits rate. So this doesn't tell us a whole lot, except that a kind of volatile number has shows us a little bit of looseness, but it doesn't suggest the layoffs level didn't change. It doesn't suggest that people are losing jobs. So this is, if I asked you, you'd say, well, the story in the labor market seems to be that companies aren't hiring and they're not firing either. And that's exactly what we got out of this.
I'm going to write that down just a sec. Okay, so if we push towards Friday, what do you? How much noise and how much reality is going to be in that? Because we have to. It's taking into account the wildfires, right?
It will take into account the wildfires, and we're getting some estimates from Wall Street economists who think we could be seeing anything as up to like 20,000 jobs lost to the fires. Now, many of those will come back. This will be a kind of a different one because a lot of businesses were destroyed. There may be people who were out of work because they couldn't get to work, and those people will come back immediately into the numbers next month. But with all the businesses that burned down, none of those people will have jobs in the near future. So it's going to take a while for that rebound to show up. But we're past the hurricanes. We're largely past, well, we will see the Christmas season layoffs if they come out. They've gotten much better at seasonally adjusting that. So that may not show a big move. But overall, we're still expecting a reasonable payrolls number, 170,000. We saw such a huge number, 256 the last month in December, and nobody's really expecting that, but nobody was expecting that in December either.
All right, Mike, what else? You got 45 seconds. What's the nerdy thing that you're working on that you're going to send me later?
Well, I've been kind of looking at trade numbers, so we'll see. At this point...
Trade Mexico, Canada, or China?
China, and what it is that the U.S. puts tariffs on. Hint, if you're a poor white woman or even poor black woman, you are discriminated against in tariffs.
Because?
Versus the wealthier.
Why?
Well, because tariffs on products like cashmere sweaters are a fraction of what they are on cotton sweaters. Yep. And champagne is tariffed at a fraction of what other
lower cost beers or something might be like. Oh, that's interesting.
So it's a weird setup, and it probably wasn't somebody's deliberate idea, but it works out that way.
See, this is, I told you, he has the stuff. All right, Mike, thanks a lot. Really appreciate it. Coming up, we'll be speaking more about tariffs and the shockwaves to the energy sector. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. And let's start with this. Shares of Moderna. This is following the nomination of RFK Jr. to run Health and Human Services. That is now, they voted in that committee. It's advancing to the full Senate for a vote. So shares, and of course he's been called an anti-vaxxer. So shares of Moderna, which makes vaccines, right now, that's responding with a decline down 4.4%. Thanks to Samantha for pointing that out. Best performing stock in the S&P 5 right now, Palantir Technology, shares jumping. The company delivering a full-year revenue forecast exceeding analyst estimates, driven by what they call, and quote, untamed organic growth in demand for its artificial intelligence software. And as a result, Palantir's shares, they are up over 25%. Estée Lauder, the worst performing stock in the S&P 500. The company projecting revenue is going to fall 10 to 12% in the current quarter, also cutting about 7,000 positions. Meantime, on the trade front, Jordan Rochester at Mizuho says, you know what, the threat of tariffs initially may actually boost U.S. data.
I think in the short term, we'll see U.S. data actually look really strong because you'll see importers front-running the tariff. So we could see the new orders components of ISM look really, really strong as importers try to get ahead of these tariffs. And so the U.S. exceptionalism trade will look very strong, and the dollar does well in Q1.
Now, as far as the Chinese tariffs and that part of the trade war, we're hearing, Paul, you mentioned this before, the White House spokeswoman speaking to reporters saying Donald Trump is going to have a call with the Chinese President Xi Jinping, and that is scheduled to happen soon. S&P 500 right now up 37 points, a rise of 0.6%, 6,031 on the index. The Dow Jones Industrial Average up 30 points. And right now the NASDAQ 100, 265 points higher. That is up 1.25%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash.
It's a lot. I don't envy your job right now. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We broadcast you live from our Interactive Broker studio right here in Midtown Manhattan. You can also check us out on YouTube. So a big part of understanding what tariff threats are is understanding what sectors they hit and the impact on those sectors. There's been a lot of reporting about how automobile companies, for example, were very concerned and calling up the White House and the administration over the weekend. So I wanted to get more on this. And joining us now is Antoine Jones. He's Bloomberg NEF head of trade and supply chains. And I should point out that Bloomberg NEF covers everything that has to do with commodities, power, transport, industry, buildings, and ag sectors. So anything that you need, they cover, and they help companies kind of figure out different strategies for that. Antoine, there's three buckets you guys looked at. One is cars, fossil fuels, and clean energy in terms of being impacted by tariffs on Mexico, Canada, and China. Can we just hit clean energy for a second? Where do we get most of that, and what would the impact be?
Yeah, what's fascinating is the one part of the tariffs that we haven't seen delayed is the ones on China. And actually, when we look at clean energy and we look at batteries, well, yeah, we'll see what happens this week. And there's that Xi conversation that's coming up on the phone call, a lot of uncertainty around that. But when you look at EV imports from China, when you look at solar imports, battery imports, the vast majority of all of that already has extremely high tariffs. This 10% blanket tariff that is referred to doesn't make a difference. Even when you look at the sort of cost differentials for some products which don't yet have that level of tariff, and there's a very specific one, which is batteries specifically for energy storage projects, the cost differential between America-made batteries and Chinese batteries is such that it doesn't really move the needle on the competitiveness front. So when you're talking about a 10% tariff, most of these products already have incredibly high tariffs on them already, much higher than 10%. And for the ones that don't have tariffs, 10% isn't going to do much.
So, I mean, from a trade, do tariffs work? Do they do what the tariff imposing country wants them to do?
So what's difficult right now is intent and working out what the tariffs are supposed to serve. Are they supposed to raise revenue? Are they supposed to encourage onshoring of manufacturing? Are they just supposed to be used for other political objectives? One, that's hard to decipher in the current environment. But let's take onshoring manufacturing, and that's a sort of perceived goal of the Trump administration. On the one hand, tariffs going up sounds great. You've got a lot of manufacturing built up locally in the US to hedge against that risk of having trade barriers. But on the other hand, when you've got tariffs being announced, disappearing, being delayed, who knows if they're coming in a month. That doesn't really provide the right market signal that you need. And actually, cost of capital goes up. And actually, a lot of that uncertainty around the policy environment that you need for really encouraging a lot of these long-term investments in infrastructure, well, that threatens them too. So it's a double-edged sword, but I would say right now, when we look at onshoring of clean energy manufacturing, for example, this kind of extreme volatility is not necessarily the most convincing investment signal in making a business case.
Going back to those, to the battery storage stuff, you said that already the price differential is so wide. Does that mean that China imports are so expensive because of existing tariffs, or the other way around?
Other way around. So what I mean is when we're talking about areas where tariffs aren't so high, like those batteries I was talking about, well, the cost of US-made batteries, which are actually quite scarce, is about twice that of a battery produced in China, and that overcapacity situation means that price is continuing to decline in China. So it means that you could even have a
tariff is like no
you
big.
could have a 60% tariff, and it wouldn't really make US-made manufacturing, US-made batteries competitive from a cost perspective. What matters a lot more is, are there going to be more measures coming around in terms of restricting the rollout of Chinese technology, and that probably matters a lot more than tariffs, and that's something that the Republican Party has been extremely keen on over the last few months.
One of the things I think we got a better appreciation for during the pandemic was this just-in-time inventory that we all grew up with. Maybe that's not the best type of strategy. Have manufacturers, has the supply chain kind of morphed away a little bit from just-in-time inventory to we better have better redundancies built into that?
So yeah, when we look at, again, I'll focus on a few select sectors. Clean energy, for example, that's a sector where we're starting to see higher stockpiles. We're starting to see more inventory build up. That's as much a result of the fact that we're seeing issues in terms of permitting and grid constraints, though. So it's hard to cut through that noise and work out exactly what the reason is. When we look at the automotive sector, the supply chains are still very lean. And we still have highly integrated North America, sort of this huge, massive factory that is North America, and these parts crossing the border sort of 7 times during the production of a vehicle. And if they get hit by a tariff every single time, that's bad news for those supply chains, which tend to be a bit leaner. So it really varies across the board.
The other area that you guys look at, too, in terms of sectors is fossil fuels, and a big part of that are oil imports into Canada. So when I cover energy, it just feels like the market's really efficient, so you just have a Canadian oil needs to re-rate enough to account for, say, a 25% tariff. What does your research show?
Yeah, well, I mean, we think it's going to be bad news for US refiners if these tariffs come in place. There might be the potential for a lower tariff if this comes in place on Canadian energy products. That probably includes a lot of the oil products we're talking about. US Gulf refiners, for example, might have to find some alternative suppliers. That increase logistics costs, that could increase prices. What's interesting as well is, the oil sector is sort of maybe more aligned with some of the Trump administration's objectives. And that was a sector that would be hit quite hard in terms of refiners who rely on that Mexican-Canadian crude coming in to then process and sell on. And it's also similar to on the data center side of things too. The US gets about half of its large power transformers, a really important piece of kit for building out the grid, from Canada and Mexico. You put up tariffs on that, well, that suddenly adds even more constraints in terms of the build out of the electricity grid, which is something which is woefully underfunded and not proceeding at anywhere near the pace that we need to make good on those ambitions in the US. So yeah, it's interesting when you see things jar as well with some of the stated wider policy objectives of the Trump administration.
All right, Antoine, thank you so much. Really appreciate it. Antoine Vanya-Jones, Head of Trade and Supply Chains for Bloomberg NEF, joining us here in our Bloomberg Interactive Brokers studio. Looking at WTI crude oil, it's kind of flat on the day, but it's been all over the place. We got to as low as, we're at $73 even right now. Got to as low as $70.60 here this morning. 73.35 is the high, so kind of whipping around a little bit there. So definitely some cross currents of news out there.
Oh, definitely. And that's why oil is so cool.
That is.
It's just the best. It has different differentials. We love that. All right, coming up, we are going to talk about Paul's favorite topic. cruises and theme parks. I mean, this is like made
Experiences.
for
It's all
Paul.
about
Like, he
experiences.
knows the stuff. Jody Laurie, Bloomberg Intelligence credit analyst, who incidentally has the best job because she
She
gets
does.
to go on these cruises and the theme parks to like do stuff for credit ratings. Anyway, we're going to get her take on the sector coming up next. This is Bloomberg Intelligence. Happy Tuesday.
Listening to Bloomberg Intelligence with Paul Sweeney and Alex Steele on Bloomberg Radio.
Happy Tuesday, everybody. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries worldwide. Let's go to one now. Jody Laurie, who arguably is one of the best jobs in the biz, Bloomberg Intelligence credit analyst for cruises and theme parks and all that fun stuff that you pay a boatload of money to go to. Okay, what's your recent work that you've had on cruise lines? Some of their earnings have been incredible. What's been your overall take?
So, Alex, yes, we do. I do actually have the best job in the world, I have to say. And I will say that the most fascinating thing is the momentum continues for the cruise lines. The booking rates continue to be very high. And we're seeing that with Royal Caribbean, we're seeing that at Carnival, and that's what management is communicating. Whether or not that continues into 26 is the question that we're grappling with, but at least for 25, it's very, very positive at the moment.
I can tell you, I'm going skiing out west next week.
Oh, you are?
The price of tickets are out of control.
Really?
Oh my
It's
God!
like $300 a lift ticket, right?
I mean, I don't know how you take a family skiing. I really don't.
You can't.
You can't. Unbelievable. So that kind of goes to the point, Jody. It seems like demand out there for experiences is still very strong. How about for a family that's thinking about a theme park trip versus maybe a cruise? How does that kind of shake out?
Yeah, so Paul, I think you hit on the major issue is that we're seeing these sort of two sets of consumers, right? The lower end consumers that are paring back or they're still doing experiences, but maybe not as lavish an experience. And then you have the high end consumers that are still doing very well. High end hotels are doing well, high end cruise lines are doing well, anything that's higher end. Now, if you put that in the perspective of theme parks, one thing that we saw in our survey that we ran in November is that for theme park vacations, the average consumer's income level is a little bit lower than the average consumer that's planning to do a cruise vacation this year. So I think that's pretty telling when you think about the cost of admission, when you think about who the target audience is, and what's going to continue the cash flow generation for the cruise lines versus what might be a little bit of a sticking point for the theme parks.
So here's what I don't get. I take a look at the terminal, and one of the top read stories is eggs spiking to $7 a dozen, right? That doesn't feel conducive to them throwing off money to go to SeaWorld. You know what I mean? Like, what's the relationship to that?
It's all a part of that same consumer bucket, right? You think of the consumer's wallet. And if they're going to the store and they're spending $7, $8 on eggs, they're going to feel that strain and they're going to say, you know what, maybe I won't go to the restaurant today. You know, maybe I'll eat at home instead. Or maybe I won't, if I do go to SeaWorld, I'm not going to spend on the extra experiences. I'm not going to spend on the extra, you know, sort of add-ons that you can spend in the park. And that's where they base a lot of their margin, right? But the bigger issue for the theme parks is that inconsistency in weather, right? They're very heavily dependent on good weather. And we saw that with most recent quarter results was the hurricanes, the, you know, fires even, anything that sort of calls to question the ability to go to the theme parks that day can really significantly impact their EBITDA.
Jody, one of the earliest memories I have of the very earliest days of the pandemic was these cruise lines rushing out to the bond market to raise cash because they knew that their business was in for a tough haul there. How are the balance sheets of some of these big cruise companies, theme park companies? How are the balance sheets these days?
So we're going to break it out to the cruise versus the theme parks in terms of their balance sheets. So for the cruise lines, you know, particularly Carnival and Royal Caribbean, they are dead set on getting to investment grade level metrics. Norwegian says that they want to as well. They've never been investment grade rated, but Carnival and Royal Caribbean are really set on keeping leverage very low. They're focused on that. Carnival's targeting 3.5 times by the end of next year, so 2026. Royal is targeting below 3 times this year. What we've modeled out is that they can both get there and get there relatively comfortably. I mean, they've been pretty aggressive in terms of deleveraging, bringing down the debt load. Viking is pretty happy where it is, so we don't see them improving much, but they also have low leverage. Now, if you think of the theme parks, they repaid their debt. They had this gravy of a year in 2022. Everybody rushed to theme parks, to regional theme parks. Since then, it hasn't been as exciting, 2022 to 23, I should say. And what we're seeing there is a little bit more of a problem. Now, SeaWorld really doesn't have that much debt outstanding. So where we're concerned there is that they start getting creative with their balance sheet again, particularly if they're finding issues in the business as a whole and they need to propel sort of, you know, the equity value improving. For Six Flags, you know, they had the merger between Six Flags and Cedar Fair, and that is resulting in much higher leverage. Management already bumped out the target of when they're bringing down leverage, and we already think that it might be a little bit harder to achieve, even pushing it out by a year and a half.
And we'll know more, I think Disney reports tomorrow morning, right? Before the bell?
Yep.
So we should definitely learn more about those theme parks. What do you think we're going to hear from then on that? We have like 45 seconds.
45 seconds. Well, I'll be watching for the theme parks and the cruise line conversation. Steve Flynn, who's an awesome analyst on my team, he covers them because it's more of a, you know, what you call TMT company, right? Telecom, media, technology. That said, they are becoming much more of an entertainment company. So there is sort of a fun element to watch them. I wish they would disclose a little bit more in terms of what they do from the cruise line as opposed to the theme park so we could have a little bit more detail, but maybe they will.
All right, well, there you go. You heard it first from Jody. All right, Jody Laurie, thank you very much. Really appreciate that. Bloomberg Intelligence credit analyst. She covers theme parks and cruises as well. What are you looking for Disney tomorrow morning? We haven't even talked about it.
Yeah, exactly. You know, we want to see continued profitability, trajectory of their streaming business. It's probably most important.
But they cannot catch Netflix. I mean,
no,
they're
that's
just
okay.
Be pea-sized.
That's okay. They don't have to keep showing improvement because we know from Netflix how the model scales. And we know they're 2 or 3 or 4 years or 5 years behind Netflix, but they'll get there. And the other thing is the theme park and the entertainment and the cruise business, because that is now the biggest profit contributor to the entire company. And they're doubling their CapEx on that business.
Okay.
So they're making a big bet there.
This is an excellent point. All right, coming up, we have another hour of Bloomberg Intelligence for our listeners. Check out Sirius XM Channel 121, presented by Oracle.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Tuesday, everybody. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We have a great hour lined up for you for Bloomberg Intelligence. We got you covered from all the angles. First, you got geopolitics. President Trump will be meeting with Prime Minister of Israel, Benjamin Netanyahu, over the next 24 hours. We'll be dissecting that with Jonathan Panickoff, Atlantic Council Director of the Scowcroft Middle East Security Initiative. So kind of what to look for in this meeting. Plus, RJ Gallo, Senior Portfolio Manager, Fixed Income and Federated Hermes. He's awesome on fixed income, and we're going to get his take, particularly after 2-year inflation break-evens continue to rise. And Geetha Ranganathan, Bloomberg Intelligence, will join us on Spotify Beats, and we're definitely going to look ahead to Disney's earnings coming out after the bell, before the bell tomorrow. But let's kick it all off for you with a Bloomberg Business Flash, and for that, we go to John Tucker.
And right now, the major averages, they're slightly higher. The NASDAQ 100 actually in the lead, up 1.2% right now, 246 points higher. The S&P 500, 34 points higher. That's up 0.6%. And right now, the Dow Jones Industrial Average is 30 points higher. This is a really interesting reaction. You had Robert F. Kennedy Jr. endorsed by the Senate Finance Committee to head the Department of Health and Human Services. He's been called an anti-vaxxer in reaction. Shares of vaccine makers, they are under pressure. Moderna, the ticker symbol mRNA, those shares right now down 4.5%. New York-based Pfizer shares, they are falling right now 2%. Tech shares helping lead the way in terms of the major averages. The biggest point movers in the S&P 500 belong to NVIDIA, Palantir Technology, Amazon, Apple, and Google parent Alphabet. And of course, after the close of regular trading today, we're going to hear from Alphabet. Meantime, with the trade war jitters, Ben Laidler at Bradesco Securities, he is focused on market fundamentals and remains pretty optimistic.
This is a very good earnings season. Earnings continue to accelerate, profit margins widen, and if we can just avoid these self-inflicted sort of worst-case scenarios on things like tariffs, I think this market is. I think this market's absolutely fine.
At midnight, the Trump administration imposed 10% tariffs on all Chinese goods. This morning, China retaliating, but their move seems more designed to avoid escalating tensions. And as we point out, Donald Trump and the Chinese President Xi Jinping, they are planning to talk on the phone this afternoon. So like yesterday with Mexico and Canada, things could change. Stay tuned. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Brokers studio. We are streaming live on YouTube as well, so head over to youtube.com, search Bloomberg Podcast Live. Norma Linda joins us here, equities reporter for Bloomberg News in our studio here. Nora is a proud graduate of the University of Virginia, and I look a very middling UVA squad in a very, very weak ACC conference. UVA had a nice road win last night, beating Pitt 73-57. So they're 11-12 on the year.
Yeah, they did. Yeah, we did. Wahoo wah.
Going nowhere.
I don't know anything we're saying
that
right now.
was a good win. Nora, what are you looking at in this market? John Tucker was just reporting that we got the indexes trading higher. What are you looking at?